Hello, everyone. Welcome to all our participants from across the Americas, from Europe and beyond. My name is Jeff Passmore, and I'm very happy to welcome you to Scaling Up 2021, Canada's 6th Annual Industrial Bioeconomy Business Conference. Some of you might be wondering where this year's theme, delivering on Canada's $200 billion industrial bioeconomy opportunity, came from. It refers to the McKinsey Global Institute report of May 2020, which suggests that the global opportunity in the industrial bioeconomy space is $2 trillion per year. Actually, the OECD has said that number is conservative. But with 9% of the world's forests and millions of acres of ag land, as well as MSW, fats, oils, and greases, in my view, there's no reason Canada cannot capture 10% of that $10 trillion market. This entire two-day event is hosted by our platinum sponsor, EcoStrat, North America's biomass supply chain experts. And just let me say a special word of thanks to Jordan Solomon, CEO of EcoStrat, who has been sponsoring Scaling Up since 2017. Jordan will be speaking at noon today on bioeconomy development opportunity zones immediately following this opening panel. Now, I just have a couple of housekeeping notes. All participants will be automatically muted and your video capabilities will be disabled. So if you have a question for our panelists, please type them into the Q&A box, not the chat box. We'll only be monitoring the Q&A box for questions. However, if you want to let someone know you are attending, you can use the chat box to say, hi, this is Jeff Passmore from Ottawa, and have a conversation and exchange email addresses. We have 409 registrations in Canada, from Whitehorse to Calgary to Saskatoon, Winnipeg, and Halifax, and in the US from Portland to Los Angeles, Houston, New York, and Washington, DC. We also have registrants from the UK, Italy, Sweden, Poland, Macedonia, India, Egypt, Uruguay, and New Zealand. It's almost a mini United Nations COP conference here. And of course, federally here in Canada, in Ottawa, the Canadian federal government, we've got registrations from Natural Resources Canada, Environment Canada, Agriculture Canada, Global Affairs, and many more, as well as many provincial governments, including BC, Alberta, Ontario, Quebec, Saskatchewan, and so on. So I know you're all interested to know who else is attending. So just as if we were all at a live conference, use the chat box to say hello. But when it comes to asking a question to our speakers, click the Q&A button and type your question into the text box. Scaling Up will then coordinate the questions and ask them on your behalf following the presentation by all panelists. The webinar is being recorded and it'll be available to all registrants on YouTube following the end of the conference. A couple of other last-minute items. If you have a Bluetooth device connected, we recommend turning it off during a Zoom meeting. And in the unlikely event we experience any major technical difficulties, a new Zoom link will be sent to you and the meeting would resume in 5 minutes. I believe we're now ready to go with our opening keynote panel. And speaking of our opening panel, our sponsor for this session is Iogen Corporation, a Canadian bio-based company that is fueling the movement to net zero. We will hear more on that subject in a few minutes from Iogen's CEO, Brian Foody. At this moment, however, it gives me great pleasure to introduce today's opening session chair, Sandy Ferguson, principal of SF Consulting in Vancouver. Sandy, over to you and your panel.
Thanks so much, Jeff. And good morning to all our attendees far and wide. And just congratulations to you, Jeff, for making another pivot as everyone is doing in these strange times we're living in. You've brought a great lineup of speakers together, and it's a real opportunity to engage and connect around the bioeconomy until we can all get together again and have a lot of fun in those side hall chats. So COP26 is underway in Glasgow now, and it has stimulated timely discussions in Canada and abroad about the challenges we're facing, near term and long term, around climate change, around the need for faster energy transition, and also the wide array of potential solutions. Today's panel is going to share their views around the energy transition and also how the bioeconomy fits in. They bring informed and varied viewpoints. So keep the Q&A box full. I'm hoping that we'll have lots of time for some good Q&A discussion after the presentations, which are relatively short. So our three speakers have very fulsome bios on the website. Please check them out if you don't already know them, which I would be surprised. To kick off, we have Chris Henderson, president of Lumos Energy, a clean energy advisory focusing on Indigenous communities, and chair of the Globe Series of Conferences and Exhibitions. Next up will be Ralph Torrey, president of Torrey Smith and Associates, a longtime climate change advisor, and most recently, director of research at Corporate Knights. Check them out, they have great webinars. And finally, Brian Foody, president and CEO of Iogen, a world leader in cellulosic ethanol and industrial enzymes, and probably the person I've learned the most from about biofuels and carbon credits. So with that, I'm going to turn it over to you, Chris.
Thanks very much, Sandy. I'm going to look at things a bit differently than you may have seen it in the industrial bioeconomy in the past. And I really come from this from a standpoint of saying, is what we're doing now going to get us where we want to get to? And so I've entitled this presentation and introductory remarks as something called Deep Shift. If I can go to the next slide. Lessons from Scotland could be about COP26, where I have a team on the ground now with Indigenous clean energy, where we're making some major announcements with renewable energy microgrids in 2 days from now. But it could also be about Scotch whiskey, which is something that both Jeff and I have an affinity for. And when you make Scotch whiskey, you look at how it's going to age, because obviously a whiskey that's 10 years old is not as valuable as or as good as a whiskey that's 15 or 20 years old. So you have to think strategically, you have to think of the long term. So I'm looking at this very much over the next 10 years, not 2050, which I find a sort of artificial date. When people tell me what the economy will be in the year 2050 or will be net zero by 2050, I find that illogical. The issue is, what are you going to do next year, 2 years from now, 3 years from now, and over the next 10 years? And I'm putting the context on it because I think we are trapped in clean tech generally, and for the industrial bioeconomy specifically, we're trapped in our current imperatives. We're trapped in the challenges of bringing innovation to market, getting beyond beta scale, getting the ramp up that we need from the demand pull for the supply of technologies, and making that commercially viable so that we have companies that are moving well. And therefore, a lot of the strategies that companies in the sector has been pursuing has been very much about the imperatives of today. It's very much akin of climate change, where countries like China and Russia are more concerned about the economies of the day rather than thinking about what they need to do about the net zero economy of the future. And effectively, I think what we're doing, if we keep doing the same things we're doing in the sector, it was doing the same things we're doing in clean tech and for bioeconomy, frankly, it's like beating your head against the wall and hoping you'll get a different result. We know what that means. Next slide. I'm going to talk about three things. And I'm going to talk about how that ties to a catalyst. What catalyst would change the situation for acceleration of the bioeconomy today? And are there different catalysts we should be looking at than the ones today? The next slide, please. People who know me know that I often refer to three things in my remarks and presentations because I think that's all people can remember. I always wonder when, they said there are 10 commandments in Christian traditions, can everyone ever name all the 10, unless you happen to be a minister? So I'm going to talk about social relevance, market synergy, and interconnected relationships that are not typical things you will see about a clean tech presentation, a clean energy future presentation, or about bioeconomy. Next slide, please. When people talk about sustainable development, they talk about obviously the intersection between economy, social, and environment. But the one that always gets the short shrift is the social. And I do believe that if one is trying to change different policies, if one was trying to build a market in the industrial bioeconomy, one has to begin with the unabashed social relevance of this. When I hear presentations or I hear pitches from companies and projects, it's very much about the project. It's very much about the technology. I don't hear the sector, enterprise, or projects talking about social impacts and value. And that has to be the business case you start with. 15 years ago, there was virtually no Indigenous community that owned or co-owned an Indigenous clean energy project in this country. And when we started doing this work with Indigenous clean energy, we focused this on the social. We focus this on Indigenous people and their communities. And today, Indigenous people own, co-own, or a defined financial benefit with almost 20% of Canada's electricity generating infrastructure, virtually all renewable. That's because we focused on people. And the essentiality of people and what it means to them is key. And that requires living the stories, sharing the stories. Again, when I hear about the bioeconomy, I hear about technologies, I hear about projects. I don't hear about people. I don't hear, for example, what the Meadow Lake Tribal Council is doing in talking about their bioeconomy project with the turbine technology in northern Saskatchewan. They talk about the people. They talk what it means for them, for their forest business. They talk about what it means in terms of their employment for the communities. They talk about what it means for their circular economy. And as a result, their project's moving ahead and got the support it needed to go ahead. Fundamental to social relevance, in our view, is integrating the Sustainable Development Goals with bioeconomy design of projects, innovations, ventures, and the market as a whole. In fact, what I'll say is that early in the new year, we'll be releasing a new book, an e-book, that integrates clean energy and the SDGs. We've identified 11 of the SDGs that if you design projects the right way, you get value that's greater. In effect, you make externalities internalities, which has been one of the major problems with clean tech. And so therefore, my first point on this presentation is that look at social relevance. I think the first thing that anyone should be talking about in the bioeconomy, especially the industrial bioeconomy, is what it means for society. And that could be within the society of the project, the company, the community, or in fact, for the more broader regional or national societies. If you're not socially relevant, you will not get the policy change and the market dynamics you see. The next slide, please. I talk about this next slide as market synergy because whenever I look at bioeconomy, and I've been involved with many companies and their boards and their managements, is that I find it's a confusing sector. We all know that. There's different products, technologies, different pathways, different modalities, and different markets you're serving. That confuses things incredibly hard. And so therefore, what I think one needs to look for is these 3 points. I thought I would do 3 things. With each of those 3 things, I'm giving you 3 points. And the first, and what we're seeing here, is where possible, the industrial bioeconomy intersection with carbon is crucial. We have seen a dramatic change in the last 6 months in the pricing and values for things like renewable energy credits and offsets. When we were selling them from Indigenous clean energy projects in June, we were selling RECs for $3 a REC. We're now selling it for $55 a REC. That's almost an order of magnitude times 2. So the carbon value definition is really having an impact because the Canadian pricing structure and the price and the regime that we have, but also globally. And commoditizing the value is really key. And the commoditizing the value may be very different for the industrial bioeconomy. It may be about forest preservation. It may be about nature services. It may be about carbon sequestration. It may be about renewable energy credits, as well as the commercial nature of the bioeconomy. And I wonder if it's time for a Canadian Bioeconomy Act. I mean, several of us, including several on this panel, were involved with the Green Energy and Economy Act in Ontario. What can I say? It was flawed in many ways, but it did many of the right things. It got us off coal and it jump-started a clean energy revolution in Canada. Do we need the same thing nationally? The next slide, please. Finally, I'd like to talk about interconnected relationships. I think what we have in the bioeconomy sector, including the industrial bioeconomy, is confused relationships. Because we have so many different kinds of products, so many different kinds of markets, so many different kinds of buyers, so many kind of different regulatory regimes, including in our lovely Canadian Constitution, 13, 14 governments. It is time, I think, to focus on 2 or 3 big clusters. And that could be what Jordan will speak about in the next session on a regional basis, but we can't be fragmented. The fragmentation is leading the market to not understand what it's about. And we can't build those interconnected relationships that really make core markets go. Pick the biggest markets, drive to that. And it may mean some people don't get the kind of support they need, but that's the way it is. You always go where the biggest bang for the buck is first. Secondly, is that elevating relationships and expanding them is key. When we work internationally, and in fact, today, for example, there was a major announcement at COP for a global energy alliance for people on the planet. Thursday, you'll see that Indigenous clean energy is a direct part of that for renewable energy microgrids. And that gives us relationships with large companies, with major funders, major banking institutions like the European Investment Bank, and major foundations like the Rockefeller Foundation. That gives us capital to do what we need to do. So we need to focus on building relationships at elevation, not dealing with it technically at the project level, but really building how the relationships that create the market. And frankly, and I'll joke on this, Jeff, is that we've got a bunch of old guys in this panel, excuse me, Sandy, as well as you're much younger than us. We really need to invest in the next generation of bioeconomy leadership. My Indigenous Clean Energy team of 25 people, the average age is just over 30. That's only because I'm a part of it. All of our staff, save 2, are under 30. 2/3 of them are Indigenous. 2/3 of them are women. They're the ones at COP. I'm not, because they are the next generation of leadership. And that's what we need to invest in, because our bioeconomy sector, I find, is getting aging, and we need that new drive there. The next and final slide, please. So therefore, what I think we need for the bioeconomy and the industrial economy is a deep shift, a mind shift. And that involves change. And what I would note, for example, with change in closing, Jeff and Sandy, is that there's a line from Red Green, the comic, who used to say, I'm a man, I can change. If I have to, I guess. So let's not guess. Let's go with a deep shift for Canada's bioeconomy. Thank you.
Thank you very much, Chris. Lots of good food for thought there, and I really encourage everyone to send your questions in. I'm going to turn it over now to Ralph Torrey.
Thank you, Sandy, and good morning or afternoon, as the case may be, everyone. I'm very pleased to be here and joining this conference, and also want to add my thanks to Jeff for this wonderful initiative, which is somehow he's managed to keep going year after year. It gets better and bigger. And also thanks for Chris for setting the stage. I couldn't agree more that we're in deep shift. If you say it fast enough, it has a double meaning. But what I wanted to speak about here this morning was really on a much narrower scope than the broad canvas that Chris has given us to think about. And in particular, I want to talk about the future role of bioenergy, which is only one component, obviously, of the bioeconomy. It always has been traditionally a byproduct. I want to talk about the future of bioenergy in the evolving energy system. And I'm not going to predict what it will be. Rather, I want to say a little bit about how to think about the question, or at least suggest to you ways of thinking about it. I've got only 2 slides. When I was thinking about putting these slides together last night, and it occurred to me what a complex system the energy system is, and how there is innovation and change happening in so many different regions of it. And all of these innovations and changes send out ripples that interact with each other. And I had this image of the surface of a pond with raindrops falling on it, and how complex the pattern becomes very quickly as the ripples begin to interact. So that's the backstory for the background image in these slides that I'm using today, and for the subtitle of my remarks, which is the future of bioenergy and the emerging energy economy. That's clear. Clear as the surface of a pond. So in this next slide of my 2 images that I wanted to share with you to support my comments, it's basically a simplified diagram of how one might think about the energy system. And I've drawn it as a pyramid. And I think the important thing to understand here, at least to understand the way that I'm putting this forward, is that the fuel and electricity markets, so that all the production and consumption of fuel, all the production and consumption of electricity, that's actually the tip of the iceberg of what constitutes the energy system in its entirety. In this diagram, I'm showing roughly what the Canadian numbers are. And our fuel and electricity markets represent about $180 billion a year. That's about 10% of the Canadian economy. You would get a similar, probably a somewhat smaller number, but a similar number in any of the rich OECD nations. And my remarks this morning are really focused on the industrial and post-industrial nations. But underneath that system, or perhaps enveloping that system, are the demands for energy services. There is no demand for fuel and electricity in a fundamental sense. We don't actually even care how much fuel and electricity costs. We think we do, but we don't really. It's not what we want. I have one visual aid that I get a kick out of. This is a AAA battery, depending whether you get the bargain brand, which is what this one is. This is called Great Value, made in China. Probably cost about $1, maybe a bit less. Produces electricity somewhere in the neighborhood of $175 a kilowatt hour. We don't care. Why should we? Because what we care about is that we put that battery into our remote control, and it contributes an infinitesimally small contribution to what we actually care about, which is, for example, the functioning, the education and the enjoyment that we get out of our home entertainment system, or whatever the remote control that this battery powers might be helping you to do. You could go on and on about these kinds of examples, and it's a fundamentally important realization which has come too late and too slow to many of the energy commodity producers who didn't look deeply into their demand chains. It's the thinking too narrowly about the nature of these markets is the reason that so many electric utilities overshot their investment strategies in the 70s and again in the 80s and again in the 2000s. And so if you are contemplating the question of what might the future role of bioenergy be in the energy system, it's important to look deeper into the demand chain to the energy services, heat, light, heat at various temperatures, information processing, mechanical power, stationary or mobile. That's pretty well the list. Those are the energy services which the fuel and electricity helps to provide. And they're in a constant change of flux right now. And they themselves are not the fundamental demands either. The fundamental demands always, and this goes back to Peter Drucker, are being driven by the demand for fundamental amenities, comfort, health, nourishment, safety, security, happiness, knowledge, self-realization ultimately. These are where these are the headwaters of the demands or the derived demands for all commodities. And if there is going to be a role, or if you're going to place a bet on the future of bioenergy in this system, you would be well advised, I would suggest, to think through all of the dynamics of the demand chain that you are trying to offer your product forward for, and not just look at it simply in terms of what's going on in the tip of this pyramid. In my second slide, I want to just elaborate on this and the importance of thinking deeply into the demand chains and devising either business strategies or public policies for the future role of bioenergy. The system throughout is in a very dynamic state. It reaches deep into the demand chains all the way to the bottom of the pyramid. The level and the mix of energy services that's being demanded is changing in response to underlying innovation and structural trends in the way that we get the amenity that we want. This in turn changes the relative opportunities and advantages of energy commodities, that is fuels and electricity, that are competing to provide those services. So to be resilient and effective and successful, policies and business strategies for the contribution of bioenergy to the future energy economy have to try and keep track of all of these moving parts. Innovation in the provision of amenity at the bottom of the pyramid is rampant. The internet, tremendous implications all the way up the pyramid. It wasn't invented to save energy. It wasn't invented to change the nature of energy services that are needed by society, but that's what it's doing. That's what it's already done. Trends in urban form, the sharing economy, even high performance buildings. Many of the innovations that go on in the bottom of the pyramid have profound effects all the way up into the energy commodity markets. But, and this is the rub, they are very often not themselves much influenced by what's going on in the energy commodity markets. The internet wasn't invented because the price of fuel and electricity was this or that, or was trending this way or that way. And yet its effect is profound on the level and the pattern of energy services that the energy commodity markets then have to provide. So you've got to think all the way down in those demand chains when you're developing scenarios and your hedging strategies for bioenergy bets in the energy system. Excuse me. Compounding the changes in the level and the pattern of energy services, there are innovations in the technologies for both the production and the utilization of fuel and electricity. Electric vehicles, cold climate heat pumps, renewable electricity supply and storage breakthroughs, advanced control systems, new technologies for the transmission of low temperature heat. All of these are changing the opportunity and the competitive landscape for energy commodities. And of course, there's pressure throughout this entire system from top to bottom to reduce greenhouse gas emissions before it is too late. Minimizing emissions in the next critical decade is especially important. Electricity, long considered shut out of the transport markets and as a last resort option for heat markets, is now increasingly considered as a central component of decarbonizing these systems. You know, when I did the first time I did what a scenario of what a post-petroleum future might look like for Canada, and that was in 1980, 81, we leaned very, very heavily into liquid fuels from bioenergy. We didn't have confidence that the electric vehicle was that we could put it in our scenarios. The heat pump was clearly not ready for prime time at that stage. So much has changed along the way. And along with continued efficiency gains, innovation in amenity provision, and decarbonization of the electricity supply, electrification has emerged as a central pillar of decarbonization strategies, especially in the rich countries. And bioenergy maintains an important role in long-term post-petroleum scenarios. In fact, the absolute growth of bioenergy in the scenarios that most of the scenarios that I've been looking at for a post-petroleum world have absolute growth rates that are high relative to the historical pattern. However, it's typically portrayed, that is, bioenergy is typically portrayed as the go-to source only when an electrification option is not feasible. And options for electrification and the related co-benefits of non-combustion technology generally continue to proliferate. Just in the last couple of months, we've seen the first electric container ship out of Norway for regional work in Northern Europe. Many of you have probably seen the stories about the test flights of electric planes over the last couple of months. These things will take time to get fully developed. But the point is that electricity is continuing to push into markets that were previously considered out of bounds for it because of the advancement of electric technology and the supporting infrastructure. Successful policies and business strategies for bioenergy in the post-petroleum energy system are going to be those that exploit these trends, including the trend to electrification, the trend to greater utilization efficiency of energy commodities, which are delivered in no small part by the trend to electrification. I mean, electrification is efficiency. The trend to an overall reduction in heat share of the energy service market, the trend towards a less energy service intensive economy, and a continued downward spiral of the efficacy of the commodity-based business plans and public policies that have characterized the fuel and electricity markets for the past century. So that's all I'm going to say for now. I only wanted to leave you with for your consideration, a model for thinking about how to think about the future of bioenergy in a system, the energy system, which is itself in a very dynamic state of transition, the likes of which we haven't seen for a long time. And if you're planning either a business strategy or a public policy for bioenergy to impact on this system, you need to be considering these complex and widespread dynamics. Thank you.
Thank you, Ralph. That was excellent. And I must say, I'm just a shade disappointed because there were more synergies with Chris than areas of differences of opinion. So I think we'll get into that a little bit when we have our Q&A. So the next person I'm going to call up is Brian Foody.
All set. Sandy, Jeff, thanks very much for the chance to speak here, and I'm looking forward to speaking with you all about the net zero energy transition. Next slide. First, though, just a brief word about Iogen and who we are. We focus on net zero fuels. We've got many years of experience. We delivered successful cellulosic ethanol technology that's up and running, that's profitable and expanding. We're one of the largest registered producers of cellulosic biofuel in the United States, a leading supplier of carbon negative fuels to California, and we're now deploying low carbon hydrogen for transportation. Next slide. So what I'm here to talk about, though, is the net zero energy transition and just give you a sense of what it might look like from the perspective of the fuels industry. Next slide. Fundamentally, our world is moving towards net zero carbon emissions, and it's no surprise that I've got windmills here and an electric vehicle. Next slide. The world is making a massive global commitment to reach net zero in 2050. Trillions of dollars, global effort, a huge deal. Next slide. And it's going to be a huge challenge to turn our energy systems around and essentially eliminate fossil fuels by 2050. You can just see from this chart the historic rise in emissions, where our business as usual path would take us up to 4 degrees centigrade, perhaps, as a warming, and I almost call it a necessary path we need to pursue in order to keep warming down to an acceptable level. That's where the net zero to 2050 challenge came from. Next slide. And when we do it, electrification is going to play a critical role. That's, to follow off what Ralph said, electricity is a centerpiece of what most people expect from this field. Next slide. There are huge expectations for early investment in electrification. The Princeton University Net Zero America project estimated there was going to be 2.5 trillion in capital investment that would have to be added across a whole bunch of sectors. And this is just a chart of all their sectors. That 2.5 trillion is just in the 2020s. So over the next year, and I don't mean for everybody to rush to try to read it, but if you were to go through it, you'd find that 50% of all of those different sector investments are about one or another form of electrification. So huge investments over the next 10 years is what's envisioned, focusing on electrification. Next slide. But I'd like to do a shout out here for low carbon fuels. They're only projected to be 3% of total investment, and 3% may seem like a small number, but it is $70 billion, which in today's low carbon fuel industry is a vast amount of money. And it's really very much only the beginning. Next slide. Because by 2050, low carbon fuels are going to need to power what can't be electrified. Almost no matter what hope you have for electrification, it has to stop somewhere. And it's widely expected that aviation, shipping, long haul trucking, high temperature industrial heat requirements, high volume firm power is going to have to come from fuels in some way or another. Next slide. And when we look to net zero, low carbon fuels paired with carbon capture will need to deliver about the same CO2 reductions as electrification. So really big deal. And this is taken from an average of 20 separate net zero studies. So it gives you sort of a general view of the world as to the relative scale of importance of low carbon fuels when paired with carbon capture. Next slide. So where does that lead us to in the fuels business? Well, roughly $1 trillion market with three major fuel types: drop-in fuels, renewable natural gas, and hydrogen. I've just taken as an example here the IEA's projections for that time, about 600 billion gallons of fuel, roughly divided equally between drop-in fuels, which are fuels that basically mimic the physical properties of gasoline and diesel, renewable natural gas, which is a direct replica virtually of natural gas, and hydrogen. Different studies give the different fuels different relative weights. Their sources are going to be from either bioenergy or from renewable electricity. Next slide. Now, bioenergy-based fuels have a critical role to play because paired with carbon capture, they can remove CO2 from the atmosphere. And that's on a really, truly grand scale. The IPCC estimates a potential for up to nearly 20% of our total emissions being removed by the combination of bioenergy and carbon capture. And let me just explain how that works on this slide. When you think about what is bioenergy all about, it's about growing plants which capture energy from the sun, carbon dioxide from the atmosphere. That CO2 that's been removed from the atmosphere is ultimately released in two spots, one during the manufacturing of fuel and the other when the fuel is used. That effectively puts a bioenergy process in the same cycle as when you grow a plant and eat it. The CO2 is removed and then reduced. It's part of the full natural carbon cycle. Of course, many biofuels today use fossil fuels in their production and are net emitters overall. But a completely renewable biofuel process would have no net greenhouse gas emissions. Next slide. Now, when I talk, though, about what bioenergy carbon capture can do, that involves effectively, I'll call it breaking the system and capturing some of the CO2 from the biofuel manufacturing and putting it where it can't escape, turning it into construction materials, putting it deep underground, and the like. That can turn bioenergy processes into processes that are net removing CO2 from the atmosphere. This is this kind of process is on the way to making even conventional corn ethanol a zero carbon emission fuel. Next slide. But even more dramatic than that, than those type of carbon reductions are what's possible with hydrogen made from biomass-based feedstock. Because hydrogen is unique in its properties. It doesn't actually, when combusted or used, release any CO2. In fact, if you produce hydrogen from plant biomass, all that CO2 is released in concentrated form in the manufacturing process. Next slide. And let me just give you an illustration of how that works. I'm just going to kind of walk through the variety of different types of hydrogen production approaches. The conventional way of producing hydrogen is from natural gas by steam methane reforming. And the so-called blue hydrogen is a leading process where you capture the carbon that comes from that process. Roughly an 85% reduction in emissions from conventional fossil fuel-based processes. Next slide. Then if you take a look at electrolysis as a means of making hydrogen, particularly if you draw on renewable electricity, you get all the way to 100% reduction. Big deal, big positive thing. When you read about the future of hydrogen, mostly people are thinking about this is an opportunity to create a zero emission fuel. Next slide. But now we get to biomass-based processes. Without carbon capture, they are roughly like electrolysis, around zero emission. But when you put carbon capture in, you can capture a huge amount of CO2, reducing emissions roughly 300%, turning biomass-based fuels into tools to reduce CO2 in the atmosphere and reverse the effects of climate change. Next slide. So now let me just talk a little bit about the fuels for the net zero energy transition and what the playing field looks like. Next slide. The dominant net zero fuels and manufacturing processes are going to need to meet 4 requirements. They're going to have to be scalable. They'll need a zero carbon footprint or better. They have to be net zero compatible and practical and cost effective. And when I say scalable, that means they have to deliver in really huge volumes and be sustainable. And that's a really serious challenge for biofuels made from food and feed crops. Next slide. Let me just give you an example. For example, the IEA, as an example, doesn't even expect biofuels from food and feed to be able to deliver 5% of 2050's net zero fuel requirements, just given those limitations. So we've got products that can deliver zero carbon footprint when fueled off renewable energy, are net zero compatible, are truly practical and cost effective, but they miss the boat on scalable. Next slide. Which brings me to biomass-based fuels. There's been enormous hopes for these fuels, which look like they'll be sustainable and they could be available in very large volumes. If you take a look at the US case, US biomass supply can deliver massive volumes of biofuel production and effectively meet the needs of net zero. And there are multiple lines of technology to deliver the cost-effective manufacturing needed. That goes from biogas and renewable natural gas to fuels like cellulosic ethanol made from the sugar platform of breaking carbohydrates into sugars, or thermochemical-based fuels that are the gasification or pyrolysis type fuels, and finally the algae platform. Next slide. And when you look at these fuels, there's some really great components to them. They're scalable, they have a zero carbon footprint, they look to be net zero compatible, but then you get to the practical and cost-effective line. Next slide. And let me just say, it has been a very long road to second generation biofuels. The truth is, billions of dollars have been spent in these fields, and it's been challenging, much tougher than people expected, and a real challenge. And many of those billions of dollars don't have much to show for them. Next slide. The bright spot so far has been RNG-based fuels, renewable natural gas. Next slide. In fact, RNG basically owns the landscape for cellulosic biofuels in the US. Annual revenues of about $2 billion, 30% per year growth under the RFS, and I might say dominant market share, but it's almost bigger than that. It's a laughably large 100% market share over the last quarter, for example. Next slide. If you said, why the dominant position? Why is it going so great? Well, relative to the competition, RNG is just very capital efficient and cost effective. This chart here just indicates the relative capital cost of RNG compared to some of the other alternatives. And the answer is, it's just way cheaper. Next slide. So why is it so cost effective? Well, it's just a very simple type of process. RNG starts with biogas from a landfill. Essentially, in a landfill, you have a gigantic anaerobic digester where microbes break the fiber and the parts of biomass down into methane and carbon dioxide. That bubbles up to the surface. It can be captured, upgraded, and turned into natural gas, effectively pure methane, and used in specialized CNG vehicles like shown here at the right. That's what that $2 billion business that I told you about is, that's been growing at 30% a year. Next slide. And while that business has been growing like gangbusters, it is facing near-term constraints on both the supply and the market side. On the supply side, there's a looming shortage of large, easily accessible landfill sites that's going to start biting in the next 2 to 3 years and probably limit the space to the 1 or 2 billion gallon range. And on the market side, there's also the fundamental constraint that CNG only reaches a niche transportation fuel market. Again, that's going to be biting relatively soon. So if we're going to say, where is this net zero coming from? We have to say, how do we address this? Next slide. And in fact, let me offer, I think it's really possible and practical for RNG to continue growing at 30% plus. There's good prospects for near-term, low-cost solutions to these constraints, but honestly, no guarantees. On the supply side, there's a lot of extra growth that can be driven by stranded biogas supplies, ones that are either too small or too remote from pipelines, new technology coming in to reach them. And the really big step forward is in the application of agricultural residues. There's already a lot of use of agricultural residues in co-processing and co-digesters, but tackling agricultural residues gives this technology the reach to deliver substantially for net zero. And on the market side, the CNG market is relatively small, but there's new high value kind of utility gas supply that's coming in that many producers are moving to, and it looked to be able to deliver a much larger market. And I think next there's the advent of renewable hydrogen as a transport fuel feedstock. That's going to offer the opportunity for very, very substantial growth. And finally, this business meets net zero through gas to liquids technology. Next slide. So the net result, I would say, is bioenergy has a clear but challenging path to delivering carbon negative fuels needed for net zero. The supply is available there, and there really are multiple lines of technology with a clear roadmap for successful net zero production. RNG is leading the pack, but it still has some challenges to resolve. And the big biochemical and thermochemical processes can still deliver. There's been a lot of money invested in them. There still is, and they offer great opportunity. Next slide. And finally, let me just say on the public policy side, public policy is going to play a critical role to ensuring that investment is there. From I'll call it first an American perspective, that involves effective implementation of existing laws. From a Canadian perspective, I think it clearly means deployment of the Clean Fuel Standard. This business is nascent relative to what needs to be delivered for net zero, but it will play and needs to play a crucial part. Next slide. Thank you very much. I really appreciate your time, and I will hand it back to Sandy.
Thanks, Brian. All right, thank you for drilling down into a bit more detail around some of the options for us. I think what I'm going to do now is ask everybody to turn their the panelists to turn your video and your sound on. I'm going to try and take some of the questions from the audience and pull them together just in the interest of time. But, you know, we do have 12 minutes, which sometimes in these panels, you don't even get 5. So we should be able to cover a fair amount of ground. Thank you, panelists, for your very interesting perspectives. I think we could have done a whole scaling up morning with the 3 of you, but in the interest of time, let's get to some of our questions. I think I'd like to start with the social side. I don't often hear this discussion other than, of course, the very real and large contributions that are made to the rural economy when we talk about biomass. But both Chris and Ralph talked a fair amount about needing to kind of change the framework and the lens. And I think maybe what we'll do is just ask, you know, in such a technology and market focused space, you know, go to any bio conference and who do you see? Mostly engineers, right? Like it has not been a major area of focus. Certainly governments value this. So I'd be interested in your thoughts, and then maybe Brian to come in as a hard-boiled entrepreneur who's been quite successful and how you see it. But let's expand a little bit on those social, and I think someone asked a question about, you know, are there some KPIs that we could be putting together that could be promoted? Some people think the SDGs might be part of that. So you might want to weave that in. So maybe we'll start with Chris and then we'll go over to Ralph, and then I'll have Brian take it home.
Thanks, Andy. One is that on the KPIs and the metrics, the book that we have coming out in January, February, the ebook does get in that for clean energy, which has some direct relevance for bioeconomy, and they break down by 11 of the SDGs, so I'll leave that aside. In terms of the social side, to me, what the social does is internalize the value of externalities. If you are protecting habitat, if you're increasing ecology and nature protection, if in fact you are creating jobs, if you're improving various economic and social benefits, while that may be relevant to governments, governments create markets, governments create policy, and governments create legislation. And so therefore, what I think the sector needs to do for projects and ventures and innovations is bring up the social dimension up front and center. And that also leads to a redesign of how projects are done. so that you in fact you maximize those social benefits. That's the strategy that we're finding to be very, very successful in the area of Indigenous clean energy, and that's what we have to share here.
And do you think investors acknowledge that? How are we doing? I mean,
hugely.
Years ago, ESG was nowhere. Now today, if you don't have an ESG strategy, you're out of luck.
Well, ESG has driven the value hugely, is driving the value of carbon. It's creating risk screens on investors. Absolutely. I mean, so if you take a social value, you get way more on that file. And that's just not on private investment, it's on project investments, on equity investment, and on government funding.
Ralph, thoughts?
Well, I mean, I would just start off by reinforcing Chris's last point. One of the things that we do in the research group here at Corporate Knights is track both the ESG performance of large companies, 8,000 large companies in the world with over $1 billion US revenue. And we also track the contribution that those companies are making with regard to where they get their revenue and where they spend their money, especially their investments. And without any doubt now, it is clear that the companies that score high on the environmental, social, and governance performance indicators, and which score high on the contribution they're making to the energy transition, are outperforming the market. I mean, it's a widening gap, actually. It wasn't clear a few years ago, but it's very clear now. Investors have figured this out, obviously. That's what they spend their time trying to do, is pick winners. And so there is a huge shift in momentum now going towards companies that are not just returning shareholder value in the narrow sense, but which are clearly moving forward with strong values in the social, governance, and environmental fields. And you know, thank goodness that we've got beyond the shareholder supremacy fixation that got us in so much trouble 20 or 30 years ago. And I can only hope and try to help this continuing trend towards emphasizing the social and governance performance of these large organizations. And the investors are reinforcing that. We're releasing a report today with Sustainable Prosperity and the Natural Step Canada, where we've evaluated the performance of Canadian pension funds with respect to ESG. And once again, notwithstanding their awful record with respect to disclosure, from what we can tell, again, it's clear that the companies that are outperforming the market are the ones that are scoring high on these metrics. So just from a purely practical point of view, even if you don't believe in bringing values in because it's the right thing to do, you should do it because it's the profitable thing to do.
And Brian, I mean, as someone who's raising capital and who's often looking for project development opportunities, what's your take on where we're at today?
Well, I got to say, I think Chris is exactly right. We all have to recognize when we talk about dealing with climate change, at its core, it's a social problem which has been an externality of the market. And as such, the private sector acting on its own has not been particularly effective in addressing it. And as Chris said, that externality has to be internalized. And the way it has been internalized is through actions of government, through legislation, creating, as a very practical way, market prices, and creating stability and solidity about those market prices. And I can assure you, in going out to raise money, people are interested in, do you have a project that people want where there's a real market and people will buy these products? And the core of it, and the core of the type of growth I've described in these existing businesses, is driven by the responsible actions of government to create markets and provide price signals to the marketplace that these are desirable. So I see a really close alignment in this, and I think wise corporate leaders see where the world is going, and that's very much why ESG is of interest, because the playing field is changing.
There was David Dodds had just a last add-on, and then we'll move into some other areas for you, Ralph. Is the higher performance of companies in ESG based on stock price, indicating desire of people to own the stock, or revenue, indicating the value of specific programs, or is it both?
It's a combination of both market cap and EBITDA, revenue, net revenue.
There's a kind of next question that leads, I think, into some other areas. I think it was somebody from Agriculture Canada, AAFC, just around this dilemma of, do we put a lot of our resources into bigger projects, larger innovation clusters, or if you're looking for social impact, what's the role of the small projects? So, I think, Chris, you kind of highlighted some of that in your comments. Do you want to just maybe take a stab at that one?
I don't think there's a dichotomy here. I think both large and small projects have great social relevance and should try to accentuate it. What I would say, Sandy, is that I think we need more scalability. And so, a bunch of small, or more likely a bunch of medium-sized projects is a very good way to go, because it recognizes the use of land and resources for bioeconomy. And so I like the idea of medium-sized projects. I go right in the abundant middle, shall we say. And in all three cases, small, medium, or large, social relevance is there. But scalable projects that can be replicable, in fact, is the one that's going to allow us to reduce costs and to magnify social benefit.
Okay, excellent. Let's talk a little bit about linkages to the oil and gas industry. We had a few questions there. Do you think the current oil and gas industry is open to transitioning some of their output to renewable fuels? And I think the question is really asking, when they don't have mandates imposed on them, are they willing to, as part of their business planning, move into that space? And maybe what I'll do is ask Brian to start with that one, and then if anybody else wants to chime in.
Well, let me just offer, in the real life, in the real world where there are mandates imposed, the answer is obviously yes. In fact, in California, a full-size 50,000 barrel a day refinery is being converted to renewable fuels manufacturing. So, and there is in some ways panic out there in the oil and gas industry to say, how can we participate in the future, and how can we be constructive and positive in the future? We shouldn't fool ourselves, though. This is 100% driven by the market and price signals that have been created in different by different regimes, and it is the actions of California through the low carbon fuel standard which have created the impetus for the rapid growth of and conversion even of refineries to biorefineries.
Any other comments from our other two panelists?
I think Brian knows the field. I don't. So Brian.
Ralph, did you want to say anything?
I think it's like you might expect. Some companies get it and some don't. And some are diversifying and some of them are going to go down with the ship, so to speak. So it's a mixed bag.
I think, we are looking now at the clean fuel standard as a Canadian standard and a mandate. So it's going to be pretty hard not to be aboard this train, in my view.
I will add, Sandy, that I think there are no, I certainly know I'm not an angel and I'm not a demon, and that's the same true for the oil and gas sector. We're all in this together. The best thing we can do, and that's what I liked about Brian's presentation and the emphasis on the circular relationships, including in terms of managing carbon and the involvement of the oil and gas sector, is we need oil and gas companies to transition. I know when I talk to oil and gas leaders, including a couple that support some things we do, I say, look, my test for whether you should support what we do is that every year more of your asset base is in the renewable basis of energy rather than the non-renewable basis of energy. And that's what I heard from Brian's presentation. So I don't think we can vilify, but I think we have to get inclusion versus isolation.
Well, if we're looking at an inclusive recovery, then it has to include everyone. So I think that's a very good point. Ralph?
Sandy, if I may, there is one sort of footnote to this conversation, which is the oil and gas industry is also looking to what else you can do with this resource besides burn it. And that will lead to a growth in the relative importance of the petrochemical segment of that industry. And it's already leading to intense innovation on possible uses of the carbon molecule besides burning it. And so going forward, I'm not sure this is great news for the bioeconomy enterprise, because the fossil fuel industry will be competing for advanced approaches to new materials based on the carbon molecule that in some cases will be in direct competition with carbon molecules from the bioeconomy sector.
So let's, we're running out of time. I think Jeff's gonna give me the virtual hook, but I do wanna I wanna ask one question of each of you. Same question, you know, here in Canada, we don't have a national bioeconomy strategy. We do have a forestry bioeconomy framework. We don't have a bioeconomy act. We do have very big targets out to 2050 now. What 3 points or 2 points, or even if you have 1 point, would you give to government in terms of how we should be moving forward in the short term? And just because, Brian, you're right beside me on my screen, I'm going to ask you first.
I would say the message, and again, this is perhaps focused in my space. I would say get the clean fuel standard right. Make sure that it's a leading standard, widely respected, and hopefully well aligned with the California low carbon fuel standard, so we can see a broad transition in the way people think about fuels.
Chris?
I would say the government, that strategy needs to look at employment in the bioeconomy sector and how, in fact, the skills base in the oil and gas sector can transition there.
Ralph, over to you. Last word.
Oh dear, pressure. I don't disagree with anything that my colleagues have said. I'm not an expert on the bioeconomy per se, but I would say that it will be particularly important with regard to the bioenergy piece of that business plans and public policies integrate with these deeper trends that are going on to connect to the social value. Fighting electrification, for example, is a mug's game. This is where the world is going, and the bioeconomy innovation needs to wrap itself around that and exploit these trends, not try and resist them.
Yeah, we don't even have a pie yet, so why try and carve up the pie? Anyways, I think I have to stop. I'm so sorry to all of you who had wonderful questions in the chat room. We might, perhaps our speakers will be able to get back to you directly. I know a lot of you know each other, so I am just going to turn it back to Jeff. Thank you so much.
Well, thank you very much, Sandy. And that was a wonderful opening panel, and none of you disappointed. And stimulating discussion and Q&As. And just to bookend something that you said, Chris, well, all panelists talked about the need for an ESG focus. I was on a presentation a week or so ago where someone indicated that the relationship was 90% of getting a successful project done. He talked about a 90-10 split, and 90% of the focus has to be on building relationships or the project is going to fail. The only other thing I'd say, Chris, is maybe next year at Scaling Up 2022, we can get some of those under 30 members of your staff up on the podium. So thanks to everyone for being there. I really appreciate your involvement. So now we're going to go straight into our next session, which is a special presentation by Jordan Solomon, CEO of EcoStrat. And EcoStrat, of course, as I mentioned earlier, is our overall event platinum sponsor. Jordan's going to speak to us about the bioeconomy development opportunity zones and the rating system that he and his colleagues at EcoStrat have developed to de-risk investments in bio-based projects in rural communities. The session is going to be chaired by Sarah Van Exan, Executive Director of GreenPAC. And I'm really happy to have Sarah here because for those who are unfamiliar, GreenPAC supports politicians of any political stripe at both the federal and provincial level who demonstrate environmental leadership. The industrial bioeconomy is a space that Sarah and GreenPAC are getting up to speed on, and we're hoping we can work together to promote the industrial bioeconomy at the political level. Sarah herself has worked at all levels of government and co-chairs a climate action group in her community. So Sarah, welcome. I hope that was a fair characterization. We've started about 5 minutes late, so you certainly have permission to run the full half hour and run 5 minutes over. Over to you, Sarah.
Great. Thanks, Jeff, and thanks everybody for having me here today. As Jeff said, I'm the executive director at GreenPact. Jeff, I missed the start of the last session. I'm sure you've done it for the conference, but I did just want to start by acknowledging that both Jordan and I today are joining you from the traditional territories of the Mississaugas of the Credit, the Anishinaabe, Chippewa, Haudenosaunee, and Wendat peoples in Toronto, which is now home to many urban Indigenous people. And I think that's, particularly important. It's always important to do, but particularly important in a conversation about land use, economic transition, and opportunity. Yes, I'm the executive director of GreenPact, but you're not here to hear about GreenPact today. I do encourage you to check us out, though, at greenpact.ca. We do a lot of work to build environmental leadership in politics, including through the endorsement of proven environmental leaders who can make it to Ottawa, to Parliament Hill here in Canada, where they can drive change, and through a really interesting parliamentary internship for the environment, which is the only environment-focused internship program in all of Canada. But as I said, you're here to hear from Jordan today. So I'd like to introduce him now. Jordan has been the president and CEO of EcoStrat for 20 years now. He's overseen the supply of more than 5 million tons of biomass feedstock to projects around North America and has led supply chain de-risking for some pretty big operations, both public and private sector, like JP Morgan, Shell, the Tennessee Valley Authority, Lafarge, Coca-Cola. I could go on, including the Canadian government. Jordan's going to speak to us today about the Bioeconomy Development Opportunity Zones, which is an initiative to accelerate and de-risk bio-based investment and infrastructure development in rural communities. And I should also point out that Canada's first biodevelopment zone was designated as A-rated last year in Melville, Saskatchewan. Congratulations to that community. Jordan's going to be speaking to us for about 15 or 20 minutes about the initiative, and then we should have some time for your questions at the end. If you could continue to put those into the Q&A instead of the chat, that would be very helpful. So I'm going to mute myself and turn it over to you, Jordan.
Thank you, Sarah, and welcome everyone. I'm very pleased to be here again at really one of the what's become certainly the preeminent, at least in the center part of the country, conferences for the country. So I'm Jordan Solomon again. I'm president of EcoStrat. I'm chairman of the Bioeconomy Development Opportunity Zone Initiative, or what we call for short the BDO Zone Initiative. I want to tell you just to start a little bit about EcoStrat. At EcoStrat, all we do is feedstock. Our advisory group is a leader in feedstock supply assessments, and over the past 25 years, we've carried out hundreds of feedstock supply due diligence assessments for leading developers and investors in new biofuel, renewable chemical, heat and power, pellet, and biogas plants. We developed the investor standards for biomass supply chain risk, with, I should say, great support from NRCan, which became a national standard for Canada just in March this year. And that standard was issued by the Canadian Standards Association and the Standards Council of Canada. And our feedstock supply group aggregates and supplies over 500,000 tons of feedstock every year. And we supply it to companies that, again, make it into biofuels, heat and power, biogas, other applications. So all this to say, we know a bit about feedstock risk and what it means to creating a sustainable future, and about capturing part of that multi-trillion-dollar industrial bioeconomy that this whole conference is about. And a sustainable future and a trillion-dollar market means a lot of things to a lot of people, but one key component to enable that future, to get access to that trillion-dollar economy, to get Canada's share of that trillion economy, is getting more advanced biofuel, more renewable chemical, more biogas, more bioproduct plants built in this country, and getting them built faster. And as Chris Henderson said earlier, it's about catalyzing change. It's about building interconnected networks. And a lot of smart people at this conference are expending a lot of brain power on many different ways to obtain that goal. But today I'm going to tell you about one new program to help make that happen. If we can have the next slide, please. This is in fact an interconnected network that I call it an interconnected economic development network to get those plants built faster. And to get those plants built faster, regardless of whether they make biofuels, regardless of whether they make renewable chemicals or biogas or clean power, or it doesn't matter. It drives those plants to distressed communities around the country where the jobs that those new plants create have the greatest impact. I'm talking about places where we've lost a pulp and paper plant, for example, in this country, and many other places. It has the ability, the BDO Zone program does, to by 2030 help create 16,000 new clean energy jobs, inject $1.5 billion in economic impact to rural communities across the nation, and reduce net GHG emissions by over 2%, which is a big deal, right? It's a move the needle type of initiative, because it's hard to understand what 2% means, but 2% is the equivalent of removing 18% of all the cars off the Canadian road, like that. So it's a big lever to catalyze bio-based economic development and help build out the clean energy infrastructure of our country. So the program is called the BDO Zone Initiative. And I'm going to talk a little bit, because I know there's a lot of federal government at this conference and on this call, what the federal government can do to help make this sustainable future, to help Canada really get our piece of that multi-trillion-dollar bioeconomy, to make that a reality. So if you were all here live, I would ask you a question. I'm going to ask you a question that I'm going to give you the answer to it. Imagine that there was a new bio-based manufacturing plant. And let's say that plant was to make utilize 1 million tons of woody biomass, of forest residue, to make SAF, sustainable aviation fuel, or 500,000 tons of organic waste like fats, oils, greases, or food waste to make renewable diesel. What is the biggest risk to securing this capital? Do you think it's market risk, the ability to sell it? Do you think it's technology risk, which is the ability to make it? Or do you think it's feedstock risk, the ability to get the biomass reliably in order to feed the plants that make it? So it's a bit of a trick question, because of course the answer is all three. But I asked this just last week to the ABLC conference in San Francisco, and there were 400 live people, real 3D people in the audience. And when I asked the first question, whether technology risk was the biggest risk, no one put up their hand. When I asked if markets risk was the biggest risk, no one put up their hand. This is a massive change, and it speaks to how rapidly this industry is evolving. And when I asked if it's feedstock risk, 75% of the audience put up their hand. So it's clear that feedstock risk is a big deal. And it's worth noting that feedstock risk, of all those risks, feedstock risk is the only non-hedgeable risk over the long term. So, it's a fact that feedstock risk is really, in terms of bio project finance, sometimes we call it the red-headed stepchild of bio project finance, because it's a massive barrier. So what I mean is that if we want to do what Chris said, and catalyze the bio-based economy, we need to solve for feedstock risk. And to the extent that we're able to solve for feedstock risk, we as a country are going to go a long way to solving for a sustainable future, and to solving for how the heck we get access to our piece of that multi-trillion-dollar bioeconomy. So in terms of what we mean by feedstock risk, can we get it reliably? This is what it means. Can we count on the supply chains? Is the price stable? If there's a question about feedstock risk, the financing of new plants is difficult and it's expensive. And the difference between securing $500 million of debt at 7% and say 5.5% can quite easily be a function of investors' perception of feedstock risks. And so what does this mean? It means that developers and investors spend a huge amount of time finding the optimal places to build new plants. And so here's the question. What if they didn't have to do that? What if these places were already found for them? What if the places where they were going to site their future plants were already found for them? So can we have the next slide, please? So I want you to imagine if there was a credit rating or something similar that investors and developers could rely on to locate the lowest risk areas from the point of view of feedstock to develop new plants. New plants for biofuels, new plants to make renewable chemicals, new plants to make biogas, new plants to make bioproducts. And imagine that in addition to verified low risk access to biomass, they also had low risk verified access to sufficient infrastructure to support their operating plant. And imagine then that those plants located in these zones had access to billions of dollars of capital from leading companies, leading capital markets like Goldman Sachs, like Citibank, and other major providers of subordinate capital and equity. So we have 4 of these zones right now. The first one, as Sarah said, was in Melville, Saskatchewan. It was A-rated late last year. They started promoting it early this year. I'll tell you about it in a second. Melville, Saskatchewan, A-rated for wheat straw. Most recently in the US, there's been Arlington, Oregon. There's been Salem Springs, Arkansas. There's been Barnwell County, North Carolina. There's more on the way. But I want you to imagine that in Canada, there were more than 100 of these zones and more than 1,000 in the US. Zones that were nominated by local municipalities that have valuable biomass assets. They have low risk supply chains. They have the infrastructure, and they have community appetite to attract the new biofuel, bio-based plant to create jobs. Do you think that would help get more plants built faster in this country? So if you're nodding your head, virtually, I can't see you. I hope some of you are. That's what the BDO zone initiative is. That's simply what it is. Can we see the next slide? So in a nutshell, the BDO zone initiative is a regional risk and certification program. It's like a credit rating, but for feedstock that enables communities, sometimes they're distressed communities, to leverage local biomass-based assets as engines for bio-based economic development, as levers to attract new plants and create jobs. So BDO zone ratings, they're just economic development tools, but they're powerful ones. They're tools to help attract bio-based manufacturing plants to areas where those plants are most likely to succeed and where they're going to have the greatest social impact. So we say that BDO zone designations enable communities, as I said before, to leverage those assets as engines for bio-based economic development. But the bottom line is that BDO zone designations solve a really big problem for our rural communities, which is that many of them have really strong bio-based assets. Many of them have tremendous surpluses of biomass. Great, reliable suppliers, good operating infrastructure to support an operating plant. But what they don't have is they don't have the platform, they don't have the credibility, and because the rural communities, they most oftentimes don't have the budget. So they don't have the platform, they don't have the credibility, and they don't have the budget to communicate the fact that there's some of the best places in the country for the next bio-based plant to investors and developers around the world. So what happens? Well, it's more like what doesn't happen. What doesn't happen is the phone doesn't ring with calls from developers, or it doesn't ring as much as it should. So next slide, please. So it's clear that markets can't act on information that the markets don't have. But BDO zone designations change that. So what they do is by carrying out rigorous, and it's not easy to get, just like it's not easy to get an AA credit rating. It's not easy to get an A rating, an A-rated BDO zone designation. But AA and A ratings signify that rigorous due diligence on feedstock supply chain, infrastructure risk has been carried out on these communities. And what the rating provides for them is something they previously lacked, which is the means to credibly stand out from the crowd and leverage their biomass to create jobs. So next slide, please. Here's what they look like. This is the designation for the city of Melville. Again, the first one. Some of you will know the city of Melville. It's a great little city of 4,500 people right in the wheat belt. You throw a stone for 500 kilometers in any direction and you hit wheat. So what do they have? They have wheat straw, right? Which is an incredible biomass asset. In fact, what the BDO zone designation showed that they have over 300,000 bone dry tons a year, every year, generated like clockwork of wheat straw. They have the farmers to harvest it. They have good infrastructure to support an operating plant. They're A-rated. You can see it's written like a lot like a credit rating because it's designed for the capital markets. You can see it says long, well, you can't see that, but it'll say things like long-term outlook on price and quantity for wheat straw is deemed stable. Key scale-up risks are addressable with key mitigation measures. That logo that you see on the left of your screen is the BDO zone label that BDO zone communities that are awarded ratings get to use to promote themselves to investors and developers around the world. Next slide. They work. And here's why we know they work. This is the data from the city of Melville. City of Melville got their rating in November last year. They started promoting it roughly in February this year. 5 months after February, 5 months, they saw 750% increase in calls from bio-based developers. That's in 5 months. This is an old slide. They've seen over 1,000% by now, and we hope for more by the end of the year. So again, there's nothing complicated about a BDO zone designation. They are a simple economic development tool like credit rating. They are designed to do nothing more than carry out suitable due diligence with the intent of making the phones ring to economic development corporations like those in the city of Melville, and then let them do their magic. They're good at that. They're good at that. And so let them attract the plants. And let's have 100 of those nodes across the country. But the benefits, look, they're not only to communities. BDO zone designations provide project developers the means of something of great value. And that's the means to distinguish one area from another on the basis of feedstock risk. And can we have the next slide, please? And I'm going to wrap up just in a few minutes. It's really important to understand why BDO zone designations are credible. And some of the government people from NRCan who are on the line here, I know, are going to recognize this framework. And BDO zone designations are credible because they're issued within the framework of government endorsed, well, they're actually government standards in Canada now, industry and capital market endorsed standards. So really, I need to thank Beth McNeil from NRCan for years past for NRCan's support to bring these standards, which we created in the US, over to Canada. And they're now a Canadian national standard, right? They were issued by as a national standard of Canada in March this year by the Canadian Standards Association and by the Standards Council of Canada. This is a national standard of Canada. So again, why are BDO zone designations credible? Why do the capital markets care that Melville got an A rating for wheat straw? Why do developers care? They care because it's not a subjective designation. BDO zone designations are credible because they are issued within the framework of a national standard of Canada, which you're looking at right there. Next slide, please. So finally, what makes BDO zones such hotbeds for bio-based development is that in addition to verified low-risk biomass, in addition to validated infrastructure, that plants located in these zones have access to billions of dollars of investment capital from leading capital markets like Goldman Sachs, like Citibank, and like others. And so if you punch into the Google machine, $1 billion in BDO Zone Investment Coalition, you will see the announcement that was made in April this year on Earth Day by the 15 members of the BDO Zone Investment Coalition of $1 billion for deployment into bio-based investments into plants located in BDO zones. That's why we should have more in Canada. Next slide, please. So here's one of the ways that BDO zone designations drive deal flow into BDO zones. And the first is that the BDO zone initiative is endorsed, and this is old news, by Invest in Canada, which is the federal government's global investment attraction and promotion agency. And Invest in Canada promotes Canadian BDO zones through their 160 global affairs offices worldwide. We just last week announced another megaphone to really help connect BDO zones with developers and investors globally. And that's a partnership with the Digest. And the Digest is the world's most widely read bioeconomy daily. Oh, there are 5 million readers of the Digest. And many of you will be familiar with the Digest Connect platform. We announced last week the BDO Zone Connect platform, which is a market-making platform where the latest BDO zones will be up there. They'll be up there with the project developers that want to site projects in those BDO zones, with the supply chain partners that de-risk the supply chain, with the tech partners that de-risk the tech in there. And we fully expect that this is going to drive enormous deal flow and make the phones ring in BDO zones. So next slide, please. In August, we had the BDO Zone Summit. Y'all are listening to me talk about bioeconomy development zones. It can be important that you hear it from the communities that want it. And we had a community panel with Mississippi Economic Development. This was all American, but you can see them there. We talked about communities stood up and said, here's why we want BDO zone designations. We had the capital markets panel. You can hear Justin from Goldman Sachs and David from Citibank and Max, who deploys $1 billion a year into the bioeconomy, for example, from Live Oak, talk about why they're all part of that capital markets BDO zone investment coalition I showed you a second ago, why they're allocated $1 billion. You can hear it from them. And you can hear it from the companies that are building these plants and from some of their associations. You also hear what the USDA thinks. Next slide, please. So what can we do in Canada? What can those of you do in the audience? Well, you can become a BDO Zone Initiative strategic partner. So there are 15 capital market members. If you're debt, if you're subordinate debt, if you're equity, you should join. This is the largest deal flow network in the country that is being built, and for the US as well. There's 15 of the major markets already joined. If you're in that space, you should join. But we have strategic alliance partners, which we're just starting to form right now. There are 3 groups: the project partner group, which are project developers, insurance, EPC contractors. You should join. If you make technology better, if you de-risk it, you should join. The communities want to hear from you. And supply chain partners. If you're a supply chain partner that de-risks and can optimize local feedstock risk. We're going to cap these groups at about 50 apiece, but at 50 apiece, they'll be robust enough, we believe, to really cause add some real value to the BDO zones. So next slide, please, and the final slide. So recommendations to government. Canada has the Clean Fuels Fund, and thank the Lord for that, we have found our way to putting $1.5 billion towards catalyzing the bioeconomy. I think what's important is that I draw attention to Stream 2 and Stream 3. We really need to ensure that applications for BDO zone designations by rural communities can qualify for Stream 2 or Stream 3 of Canada's Clean Fuel Fund. Stream 2 is only $30 million, but for establishing biomass supply chains, we think it fits. But as these programs are being, discussed and finalized within government, it's very important that BDO zone designations are considered in there. Stream 3 as well, developing and enabling codes and standards. We recommend in the US a similar act to what we're recommending for Canada. We call it the BDO Zone Grant Program Act. And we think that the federal government, if it's as serious as we know it is about developing and helping catalyze the bio-based economy in the country, that they should provide $5 million to do that. $5 million fund that distressed communities across the country could tap, communities that have lost a pulp and paper plant, for example. They should be able to tap this fund to obtain this powerful economic development instrument, a BDO zone designation, and let's give them some funding to promote it as well, right? $5 million would enable easily 100 BDO zone communities. Right now, these are distressed communities. There are many of them in Canada that want BDO zone designations, but guess what? They don't have the funding to get it. The federal government should make that available, we believe. So with that, I'm going to thank everyone for their attention. And last slide, please. Anything I'm talking to you about, you can find on the website at bdozone.org or contact me. Thank you very much.
Thanks, Jordan. That was a really interesting presentation. Congratulations on getting the initiative off the ground. And I guess we said there are 4 in the US now and 1 in Canada. So yeah, so congratulations also on these first 5 BDO zones. We have a few minutes for questions. Again, just a reminder that you can place them into the Q&A function. And Jeff is going to give me a bit of the cane if I let these questions go on a bit too long. I wanted to start with one. So we said there are 4 so far. 100 BDO zones seems like it may be ambitious. I just wonder if you could start with, why do you think there are 100 zones out there in Canada?
Well, that's a fantastic question. And we don't think it's ambitious at all. And I'll tell you why. Because BDO zones designations are issued pertaining to a particular biomass category. So there would be BDO zone designations for woody biomass. There'd be BDO zone designations for construction and demolition or post-industrial woody biomass would be a different BDO zone designation. And for food waste and for farm waste, for example, and different kinds of agricultural residues like wheat straw, like corn stover, etc. And so, we can easily see across the country, certainly 7 to 10 minimum categories of biomass that are the preferred feedstock sources for renewable chemicals, biofuels, biogas, and then, at least, 10 of them of each of those across the country, you're very quickly adding up to many more than 100. So we think quite easily there can be 100 BDO zones. And once you have, 1 or 2 or 10 doesn't catalyze bio-based development, but 100 really starts to catalyze bio-based development because you have then an interconnected network. You've really created some efficiencies for investors and developers globally. Oh, I'm building a plant that needs wheat straw to make wheat straw-based pulp, for example. Wait, there's 6 different A-rated BDO zones, which there's not, by the way, right now. There's 1 in Saskatchewan. Well, I think I'm going to call up those EDAs in Saskatchewan and start those discussions right now to site my next 3 plants there. That's the idea.
Okay, great. So, and you highlighted different types of feedstock in that answer. So we do have a question here about whether you could address how the zone concept would work with forestry biomass, where the forestry companies who have tenure on crown lands here in Canada largely influence the quantity and type of fiber.
Well, that's exactly right, and they do. And it's very, very important that that this program and this initiative doesn't stress or add additional stress on our already stressed and very valuable pulp and paper plants. And, the other existing infrastructure and operating and sectors that utilize our woody biomass. I mean, they're under enough pressure as it is. The idea is not to give more pressure to them. And in point of fact, though, there are many areas, and woody is no exception, where there are surpluses of woody biomass. For example, maybe the softwood's being used, but the poplar's not, right? The hardwood's not. This can be a designated BDO zone for poplar only. And so we have been in deep discussions with CRIBE in Ontario and others to help identify where those pockets are, and those are the pockets that are really the ideal geographic areas that should be targeted as BDO zones.
Thanks, Jordan. We have a question here that appears to come from a township, so I'm going to make sure that I answer it because this could be potential interest in a municipality dominating their community. Do the standards, Jordan, take account of contingency, in the event of supply loss due to crop disasters or infestation, drought, climate-driven drought? What if a BDO zone community is unable to fill its demand for feedstock as demand increases?
So this is a fantastic question. The answer is the standards for biomass supply chain risk, which are the framework for BDO zone designations, are a very, very elegant and complete framework. In fact, there consist of over 126 different individual risk factors, including forest fire, impact of drought, potential likelihood of, these are complicated forecasting risk indicators. No rating, a rating isn't a prophecy, okay, I guess I would say. No rating is 100%. They indicate propensities of risk, and they do that within a spectrum of a margin of error. So for example, an A rating by Standard & Poor's or Moody's or Fitch doesn't guarantee 100% that a lendee will repay what they borrowed. But it does do something very important that's catalytic to credit, which is allow investors to quickly sort the risks they want to deal with from the ones they don't. And just in exactly the same way, a BDO zone designation allows developers and investors to quickly sort and to areas they want to potentially develop their plant on. A BDO zone designation is no substitute for a proper granular feedstock risk assessment for a particular project, right? Just like no one's going to lend $1 billion basis only an S&P credit rating. They will do additional due diligence, but it's a fantastic starting point, and it's a catalytic starting point, and that's really, I think, the answer to that question. Does that make sense?
Yeah, it makes sense to me. Jordan, there are other questions, and maybe I'll just give you one to wrap up. I'm kind of pressing my luck here with Jeff because we're 3 minutes over the time that he's allocated for us. But I wonder if you could just give us a bit of an update on what's happening in the US. Like, are the goals different there? Has the response of government been different there? Is there anything you've seen from government there that informs what the initiative would be looking for from government here in Canada?
Well, the goals are really the same. The emphasis is more on distressed communities. So communities in the US with more than 25% of the population below the poverty line. Those communities in the US have access to some very powerful multi-billion-dollar federal tax incentives like the new market tax credit, like the opportunity zone tax credit, which can be supercharged or levered by the BDO zone initiative here. So the goal is different in the US. It's 1,000 in 5. We're working with several representatives in the US right now to hopefully before December introduce a bill into Congress to allocate $20 million a year, so $140 million to give distressed communities some money to a fund really to tap again to obtain and promote BDO zone designation. So the program has been socialized all the way up to Secretary Vilsack, all the staff, and it's very, very well received there. So we fully expect there to be many, many BDO zone designations in the US. And look, when you catalyze bio-based development on a big scale, you catalyze investment in individual projects, right? And I think that's so important because, and then I'll wrap with this. just even a small project can be transformative to a rural community or a distressed community. And a large project like a SAF project, a sustainable aviation fuel project, which on average, you're talking about 300 jobs a year, $30 million a year into a local economy, and maybe a $500 million build. These are transformative to rural communities. And by the way, woody biomass is one of the target feedstocks for SAF. And our old pulp and paper plants should all be designated, as long as they're not going to go back to pulp and paper. Again, we don't want to compete, but if there's never going to be a pulp and paper in an old pulp and paper plant site, before that infrastructure is gone from the forest,
I need to start my video, and
they should be designated as BDO zone designation. So with that, I'm going to wrap. Thank you very much, Sarah. Thank you, Jeff. Thank you.
Yeah, thanks, Jordan. And I think we heard Jeff pop in there for a second, which is a good sign we do need to wrap. Jordan, thanks for the really interesting presentation. I think it's fabulous to learn about a sort of a market-driven initiative like this, where what you're looking for government is to enable the innovation and the market to open up rather than propping it up on an ongoing basis. There are a lot of questions here that I hope Jeff will be able to share. And as Sandy said in the last session, hopefully Jordan can follow up with you afterwards. Jeff, thanks for having us. I hope to all the participants out there, you enjoy the rest of the conference.
Well, thank you very much, Sarah, and thank you, Jordan. And actually, Sarah, I thought you did a lovely job considering this is a new space for you. So, Jordan, I do have a comment or a question, if it's okay. I wonder if, Jake, you can put the screen back so I can see people's faces. There we go. Jordan, I think you answered this question in one of your previous answers, but does the rating take into account competing uses for the feedstock? And I think the answer to that was yes, because you mentioned some 150 odd criteria that you look at, but I just wanted to ask that question. And then the second question I had, you mentioned that a number of US communities are standing up and saying, we would love to have a rating, a BDO zone rating coming into our community. Have you got the same happening in Canada, where Canadian communities are standing up and saying, come and see us, we want to be the next Melville?
Well, yeah, actually we do. So, but the answer to the first question, really, well, let me answer the second question first. The second question is in Canada, Medicine Hat, for example, wants a BDO zone designation. The mayor of Regina, she's so fantastic. She said, we want to be the second BDO zone designation in Canada. I mean, there are probably 8 different local communities that want the designation, but there is no fund right now that they can easily tap that fits to give them the support that they need to get it. So, it's really important that we change that dynamic because, again, these are poor communities, and they need to be supported. They need to be supported. And to the first question, which I'll answer now, do they screen for or what if there's not enough material? What do they take into account competition? And the answer is yes, they do. A BDO zone will not get an A or a AA rating unless there's a minimum of 3 times more feedstock available than is currently being intaken by existing or competing markets. There must be, number one, a surplus of feedstock. There must be verified anchor suppliers on the ground that are willing to supply it, and there must be good validated infrastructure to support an operating plant. So the answer is yes, Jeff. Thank you.
Well, actually, that's a very good number, because back in my Iogen days from 98 to 2000, when we were looking at feedstock availability, we used a similar 33% availability. So that, I think you've got the right number there. So thank you for that. Listen, this has been a very good presentation, and it's just an exciting opportunity that's being presented by Bioeconomy Development Opportunity Zones, and there's certainly a lot of interest in this space. So now what we need to do is get on with the job of developing these BDO zones across North America as soon as possible. Thank you to everyone for staying on, even though we ran a few minutes late. And we now have a 75-minute refreshment break to give you all time to think about what you've just heard. and to network with fellow registrants through the chat box, because the chat box is going to stay open during this break. So you don't have to get off if you want to continue to chat with somebody or exchange email addresses with other people to find out who's on that you'd like to talk to. Our next session is going to begin at 1400 hours Eastern time. That's 2 p.m. And it's going to feature 2 scaling up case studies, Steeper Energy Canada Limited and Advonix International Corporation. So with that, I'm going to sign off until such time as we come back at 1400 hours. And thanks to all of you for your participation this morning.
Yeah. Oh, okay. So here's our legal disclaimer. And while you glance over that, I just want to say that it's great to be able to speak with you today. If you work for an energy company or within the refining industry or forestry or agriculture, I hope that my presentation provides you with some ideas and some and alternatives to what you're doing today. So Steeper Energy envisions itself to be a global leader for the conversion of low value residual biomass to green valuable resources. And those resources primarily target advanced biofuels. So in essence, we take low value waste biomass and convert it into green drop-in biofuels to offset petroleum usage while creating substantial greenhouse gas reductions. Our proven thermochemical process is called hydrofaction. It's ideally suited for converting biomass waste with high water content. So just before I go, can you see my presentation or can you see my notes? I'm kind of confused at this point.
We can see your presentation.
Okay, perfect. Because the box disappeared on my screen. So yeah, anyway, our process is called hydrofaction. It significantly reduces carbon intensity. It's validated by industry, governments, and very well suited for high moisture biomass waste. Yeah, there are plenty of environmental, social, and economic drivers that create a business case for our technology. And feedstock sustainability and acceptability are global issues. So food versus fuel, land use change, culture and biodiversity are concerns in the build out of first generation biofuels. And that's why we target waste resources for feedstocks such as forestry slash or well, actually forestry slash is a great example because it's collected, piled up and burnt on site, or it's spread out and left to decompose. So that's a waste stream that contributes to greenhouse gases where you can make fuels out of it. Our technology is a perfect replacement for fossil-based fuels. Our products, perfect replacement for fossil-based fuels. And they're key to reducing the carbon intensity of heavy and long-haul transport. Our technology extends the usefulness of the internal combustion engine by decarbonizing the fuel that it relies on. And hydrofaction makes use of established petroleum infrastructure that enables a cost-effective transition to renewables. Okay, hydrofaction is an advanced form of hydrothermal liquefaction, which is recognized by the US Department of Energy, as well as the European Commission and others, as being an exceptionally cost and resource efficient technology for biofuels production with really high potential greenhouse gas mitigation for heavy transport. We use low-cost catalysts and supercritical chemistry to convert wet biomass directly into oil, into clean water, and into biogenic CO2-rich gas. Our process is really efficient because water isn't, unlike other thermochemical processes, we don't boil off water. It's not lost to evaporation. It's rather extracted, and clean water is a product of the process. Our oil retains more than 80% of the biomass incoming energy, as well as external energy supplied to the process. That's a really high number. So it's primarily targeting making a liquid fuel that retains as much energy as possible as what's coming in. With some modification, our oil is an excellent substitute for fossil crude oil because it has low oxygen content, it has high thermal stability, and very high energy density. So we can upgrade our oil to diesel, to jet, to gasoline, and marine fuels. And on the slide, you'll see that roughly 76 green tons of forestry waste produces about 100 barrels of hydrofaction oil. And that can be upgraded to various combinations of finished fuels, depending on market demand. We've shown that our oil can be upgraded directly to finished fuels and that it can also be co-processed with petroleum. So that's how we make use of existing infrastructure. We're working on other applications such as biolubricants, bioplastics, fine chemicals, and biobinders for composite materials. And we've demonstrated that our upgraded oil products are compatible and blendable with petroleum-based marine fuels and ultra-low sulfur diesel while meeting the relevant industrial specifications. We believe we can make a real difference to our global environmental footprint with advanced biofuels. There are nearly 2 billion dry tons annually of non-food, non-merchantable forestry and agricultural biomass residues. In our case, that equals, or that's equivalent to 7,000 commercial plants, hydrofaction commercial plants, or 14 million barrels a day of our hydrofaction oil, which can meet 34% of global diesel, jet fuel, and marine fuel demand. So really substantial numbers that have the potential of meeting more than 18% of the 2030 global greenhouse gas emission reduction targets. We've been around for a while. We've been around since 2011. In 2013, we built our first pilot plant at Aalborg University in Denmark. It's since run over 5,000 operating hours, generating know-how and design data. In 2016, 2017, in that timeframe, we attracted our first commercial licensee, which is Silva Green Fuel, and they're building a demonstration plant. In 2020, 2021, we built our Advanced Biofuel Center here in Calgary, Alberta, and that's focused on demonstrating the pathways to finished fuels, to refiners and fuel consumers, to our customers. And to protect our investment, we've been really successful in developing a patent portfolio. We have over 25 patent families with over 150 patents granted internationally. So Silva Green Fuel, our first commercial licensee, when they approached us, they were in the middle of a very large diligence process on various fuel pathways, renewables pathways. We're one of 40 chosen companies, and they ended up selecting us as the technology to license. So we're quite fortunate that happened. But basically, Silva Green Fuel is a collaboration between Statkraft, which is Europe's largest generator of renewable energy, and also Norway's state-owned energy company, and Sudra, which is a large Swedish forestry cooperative with over 53,000 forest owners. They're large entities that have a really focused strategic drive towards decarbonization and deploying renewable fuels technology. So with Silva Green Fuel, we're carrying out a commercialization in 2 phases. The first phase is a demonstration plant. It's a 50 million euro commercial demonstration plant that is built in Tofte, Norway. It's going through commissioning and startup as we speak. And the second phase will be a commercial plant capable of producing about 100,000 fuel tons of hydrofaction oil per annum. And it'll be built next to the demonstration plant. So here I have some pictures. First, we have the site that Silva Green Fuel chose for the demonstration plant. It's a brownfield pulp mill site. Then our design concept. I mean, we went through countless iterations of engineering and re-engineering just to get this right. We had a lot of design data. We actually designed a commercial plant and then downscaled the commercial plant to get all of the core pieces of equipment into this design. So it went from site to concept, then some construction activity, and then real steel on the ground. So today, this plant looks like what's shown in the top left picture on this slide. It's, like I said, it's starting up. Silva Green Fuel and Steeper in the coming months will have a fully operational demonstration plant that serves as an industrial scale reference. We'll have continuously available operational data, ongoing learnings. We'll have proven and tested all of the equipment that will be used in commercial plants. So we'll have a world-class facility up and operating, but that's not the full story. We need to also demonstrate how we take the oil that facility produces and how it integrates into the beyond petroleum value chain. And that's why we built our Advanced Biofuel Center in Calgary. And this center is it's a highly specialized lab. It enhances our upgrading and refinery co-processing capabilities. Within the center, we're maximizing the value of our hydrofaction oil. We're improving our product stability, blendability, and compatibility with petroleum intermediates and finished fuels. We're also showing our partners, refiners, and end users how to successfully integrate our products into their operations. We're developing economic pathways to renewable fuels, and we're delivering choices and product options to project licensees. It's a critical component of scaling up our technology, and it's actually a really big piece of the Steeper Energy story. The center has also allowed us to increase the pace of commercialization because we've essentially eliminated the lag time in working with external labs, universities, research institutes. We still work with them, but we don't depend on them to do all of our work. So we do as much of it in-house as possible, and we're making rapid progress on the upgrading side. I can't say enough about our team. The initiative has required a highly specialized focus, and it really wouldn't be possible without a diverse and international team of scientists, technologists, and engineers. Some of our team appear in these photos, but you can imagine we're spread across 2 countries, and we have a really good mix of people here. So on this slide, we're highlighting some of our finished products or some of our products. So the picture on the top right-hand side is our hydrofaction oil. The next picture is partially upgraded light ends. And then we have finished fuels, the various cuts of our finished fuels. And this is a photo of the diesel fraction of the finished fuels, and then gasoline and jet fuel. Our greenhouse gas reduction potential is also substantial. External studies have indicated that hydrothermal liquefaction, on which our technology is based, provides the lowest greenhouse gas emissions intensity at the lowest fuel selling price. Our internal studies show that over 70% greenhouse gas reduction is achievable as a base case, and over 100% greenhouse gas reduction is possible when carbon capture, utilization, sequestration, or power to X options, or using a green grid, various things contribute to it. When you include things like that, you can get the technology into carbon sink territory. We believe hydrofaction is the most carbon and cost competitive advanced biofuel solution for producing globally relevant volumes of heavy and long haul transportation fuels. We're highly active in Europe and in North America. We have a pilot plant in Denmark. We have a demonstration plant in Norway. And with the help of a substantial grant from Emissions Reduction Alberta through their Food Farming and Forestry Challenge, we're supporting the upgrading research and development work at our Advanced Biofuel Center at Calgary, as well as project development activities in Alberta. So in summary, we're making rapid progress towards commercial adoption. Once again, our technology efficiently converts biomass feedstocks into biocrude oil that's upgradable to advanced biofuels such as diesel, marine, and jet fuel. We've established ourselves as a leader in the hydrothermal liquefaction space with substantial background expertise and patents encompassing all critical aspects of our technology. Over 100 million has been invested by owners, by licensees, and granting authorities, leading to one of the world's largest advanced biofuels projects in Tofte, Norway. And we're nearly ready to launch a globally significant biofuels technology that'll substantially reduce greenhouse gas emissions while having broad applicability to the heavy transport sector. So if you're interested in learning more or doing a deep dive into our technology, please feel free to reach out to me. My email address is here, ag@steeperenergy.com. Thank you.
Well, thank you very much, Alex. And I think we definitely have a clearer idea now of what Steeper's doing and your path to commercialization. And we'll get to the Q&As after Chad has had an opportunity to present his slides. Now, I understand from our tech support, Chad, that you are also going to share your slides and advance them yourself. So over to you, Chad.
Yes, thank you. Appreciate your organizing this event, Jeff, and look forward to sharing experiences and ideas with everyone who's on the conference. Let me start sharing my screen here. Let's see. All right, how's that? Can you see my screen? Uh-oh.
I don't see anything at the moment. Just Chad.
Yeah.
Just a second. I'm just going to ask tech support a question. Hang on.
I see my slides on the,
Okay, Chad, we can we seem to have this fixed now, so we will advance your slides for you if you just want to go through them. Can you see? Can you? Yeah. Okay.
Yeah.
Eva, I think you have the first Advonic slide up.
Yep.
Okay, you go ahead.
Excellent. Well, thank you for inviting me, Jeff. And what I'd like to do is to tell you a little bit about Advonics and where we are going. We're not quite as advanced as Alex is with his company, but we're certainly doing something very different. As you can see from what we're trying to do here in terms of the pictures there, we're not focused on fuels. Our interest is in replacing the petrochemicals that go into a whole host of industries that are, larger in molecule size than the fuels that Alex and Brian Foody had spoken about earlier today. Next slide. So what we do is make alternatives to petrochemicals. These are green, clean, and vegan certified products. And this technology has been recognized by a variety of different organizations as Innovation of the Year in 2018. Since some of our products go into the personal care area, we've been recognized by some of the beauty organizations for our innovation. So what we do is replace petroleum-based chemicals with sustainable alternatives. Next slide. The way we do this is we start with basically any seed crop. So we start with a seed crop, extract the oil, and then use the oil to create our finished products. So we can use soybean oil, canola, coconut, palm, corn, algae. We can even use non-food oils that come from things like jatropha or pungamia. Anything that has a triglyceride we can use. In fact, we can actually even use animal fat in our process. So basically our process is a three-step process. We split the oils into fatty acids. We take those fatty acids and through a proprietary electrochemical process, transform them into pure hydrocarbons. These become long linear chains of hydrocarbons, which are essentially waxes. And then through fairly standard hydrofinishing processes, turn that into a variety of different liquids of different sizes, depending on what the market is. We've demonstrated the entire process in the laboratory and have been generating products for a variety of different markets, and some of which I'll tell you a little bit about. Next slide. So our first market is for personal care. The personal care industry is very concerned about providing safe ingredients for all sorts of applications, hair care, skin care, color cosmetics. All of these have various types of oils or waxes in them, and everyone wants something that is safe and effective. So we replace volatile oils, such as that are used in hairspray, where you have a oil that carries the active ingredients to your hair and then evaporates very quickly. On the other end, we have skincare lotions, such as lip balms and sun care products that stay on your skin and provide protection and moisture for the skin. On the industrial side, we're working on lubricants for industrial and automotive applications, on adhesives. These are adhesives used for engineered wood products, for example. Your hot glue gun, for example, has waxes in it that are today derived from petroleum. But in the future, we'll replace that with a plant-based wax material. In addition, we're working with several companies on applying our oils to transformer and EV battery coolant applications. And one of the interesting ideas here is that with an EV battery coolant that's made from hydrocarbons, you can use a single fluid for a variety of different applications on the vehicle. In addition to cooling, it can also be used as a lubricant as well. And so you have a single fluid that provides all these different alternatives. Next slide. So the way we've built the company up is we have developed strategic partnerships with significant players in various markets. In 2016, we built a partnership with Minnesota soybean processors to provide soybean oil as a feedstock for our materials processing. In 2018, we signed a raw materials agreement with Valvoline to provide base oil for them to produce automotive grade lubricants. With their help, we've been able to demonstrate that we can produce a Group 3 plus lubricant for an automotive application that has better lubricating properties, better viscosity properties, and lower volatility than any lubricant that's on the market today. Just earlier this year, we signed an agreement with Lubrizol to supply them with ingredients for the personal care market. And we're working with them to get through all the regulatory testing that's required to meet stringent needs of that industry. So through these partnerships, we've been able to develop our technology and build demand in the marketplace. Next slide. So currently what we're doing is we're building what we call a pilot plant. And this pilot plant would be able to produce about 300 tons per year of our various ingredients. We're in the midst of doing the engineering work on that pilot plant right now. We will begin construction of that pilot plant in the spring of 2023. It will be operational by the end of the year, or at least that is our hope. And that will be located here in our Brockville, Ontario site, which is permitted for that particular pilot plant. For commercial quantities, we expect to scale up by a factor of about 25 or so to about 8,500 tons per year capacity. And we expect to get the funding for that once our pilot plant is operational. And the location of that will be determined based on customer requirements as well as what feedstock we would use. So we've got some work to do before we get to that commercial scale. And some of the challenges that I think everyone understands especially in this time of COVID, have to do with disrupted delivery schedules, not just for equipment, but for raw materials and other ingredients that go into our production. And there's a huge manpower shortage. We're looking for people that can help with our operations, and people are not yet ready to jump back into the workplace, taking their time to get back in. So those are some of the challenges that I think we're facing. So our approach has always been to use existing process equipment, which comes from a variety of other industrial processes. And these processes are in the oleochemical and petrochemical industries. So that's how we are minimizing the risk of what we are trying to do here. So I think with that, I'm going to basically go to the last slide and turn things over to Jeff for questions and answers.
Great, thank you very much, Chad. That's fascinating, interesting. I mean, and certainly there's a huge demand for personal care products that are safe and cost effective. And we've already got questions coming in here. So for steeper, for you, Alex, what kind of upgrading is required of the hydrofaction oil to be able to blend into the main fuel business? And then I guess there's another question here that maybe you can answer them both at the same time. What kind of temperatures, pressures do you use? And does particle size matter for your process? So 2 questions for you, Alex.
So particle size does matter, but we generate, I'll start backwards. Coming from the feedstock, we generate our own particle size by basically grinding the feedstock down to a certain level and then making it into a slurry. We add water and then we pump it through our process. So we have complete control over particle size. How the feedstock comes in isn't much of a concern for us because we do it that way. The second question is what kind of, I think it was what kind of temperatures and pressures do we use? I assume that's on the hydrofaction side. We operate at supercritical conditions. So I believe that's 400 degrees, about 400 degrees Celsius and 300 bar. We're actually on the temperature and pressure side, not the temperature, but at the pressure side, we're true supercritical, where our competitors are subcritical. And that gives us an advantage of having a higher yield, low oxygen content in the biocrude that we produce. Now, the biocrude, to answer the third question, it has some residual oxygen in it. So that needs to be removed as part of standard refinery, whether it's co-processing or upgrading, but you do that with hydrogen addition. So hydro treatment is required, or hydro processing is required, just like standard refinery processes do. We have our unique take on it, but that's essentially what happens. Did I miss anything?
No, Alex, I think that covered the 3 questions. If it didn't, then I'm sure the questioners will get back and ask for further clarification. Chad, I was interested in something that you said about, you're not quite as advanced as steeper. And yet, as I understand it, you always hear about companies when you're out there in the market and you're advancing from research to pilot and pilot to demo and demo to full-scale commercial. You always hear about companies being pre-revenue. And yet, is it not correct that Advonics does have a certain amount of revenue, even from your initial work that you're doing? And maybe, Alex, you could talk about the stage you're at too, in terms of when you will cease to be pre-revenue and actually making some money.
Yeah, we do have revenues right now. A lot of our revenues are sort of joint development projects, as well as supplying materials for testing purposes. And and we because we've got a very small lab scale production facility, we cannot meet the demand, and that's why we're building this pilot facility to try to get up to speed as much as possible. So we expect that once the pilot plant is operational and at capacity, we will be a profitable organization.
Actually, that's very encouraging that you already can't meet demand. It reminds me of a session earlier where we talked about the demand for sustainable aviation fuels, and the airlines are we can't meet their demand for SAF, and so in the personal care product business, yeah, I can imagine that as soon as you build your facility, you're going to be then once you get finished with pilot, you're going to be like, we need the demo plant now because we still can't meet the demand. So
right.
Yeah, but great, congratulations on that. And Alex, did you have some comments about revenue?
Yeah, I mean, I could kind of say the same thing. We do have revenues. It's generated from interest, like very serious companies that are trying to advance projects. We once in a while we'll supply oil, or we'll sell oil for evaluation purposes or whatever. We'll do some engineering work, but we're laser focused on things that are real, because we have limited capacity to small engineering team, limited capacity. So our efforts really are advancing the Silver Green Fuel project, and hopefully getting that to from demonstration. The next one is commercial scale. So everybody's watching the demonstration plant right now. Once it's operational, I think a lot of opportunities really open for us to increase revenues as well.
Well, while we're on the topic of money, I see a question here from my lawyer friend in Toronto, Jay Shepard, asking, are either of your companies backed by venture capitalists? And if so, are you able to share which VCs are invested?
Advonics only has investments from its partners. So we do not have any VCs right now. But as with any early stage company, we're always in fundraising mode. So if there are VCs out there, be happy to talk to them.
Okay, well, maybe put your contact information in the chat box, Chad, and Jay will get in touch with you. And what about you, Alex?
We're funded by 4 individuals, and 2 of them are the founders, Steen Iverson and Perry Toms, and 2 are part of Tom Capital and partners. But it is a private equity firm. It's basically a family-owned private equity firm that has very targeted investments, and they're long-term investors in Steeper Energy. So I wouldn't really call them traditional venture capital.
No, and that sounds like angel investors.
Well, they're more than that.
Yes, they're more than that. But well, listen, here's another question for both of you, which is, what can the Canadian government do to support the development of both domestic and global markets? Is that either you want to take that?
Well, I think the issue is, where do you start? There is a lot that the Canadian government is doing, but I think that there are some gaps in what is going on. Certainly, organizations like STDC are very good at helping develop larger scale projects. But the issue really is, when you go beyond that, there's a gap between that and commercial facilities. These are all capital intensive projects, and you need to have some people that are willing to put the money in for a first commercial plant, and that, I think, is one of the gaps that is missing in Canada.
So,
Alex, do you have any thoughts on that?
Yeah, I can add to that. I'll speak for the industry. I mean, advanced biofuels in general, and I'm sure Ian Thompson will add to this later on. But clean fuel standard, that's huge for our industry. I mean, so stay the course with that. Look to BC, look to how British Columbia has built out the industry with the low carbon fuel standard there. Support, and this is a big one for me personally, support the energy industry in making the renewables transition. Because there are a lot of solutions, and people are trying to make the transition, but do whatever it takes to help existing refineries, existing oil and gas companies take renewables, biofuels, feed it into existing infrastructure to make use of what we already have.
Alex, here's a question that's directed at you, which is, what about zero electric vehicles and hydrogen? Where do you see your technology fitting into the renewable fuels market, which is kind of a follow-up to the answer you just gave?
Yeah, that's a good one. I mean, they have a place, and I think Brian was showing a graphic of how much is being invested on the electrical side. It can only go so far. With long haul transport, if you can imagine ships going across the ocean, I can't see batteries, maybe, well, not in the near future, batteries taking ships across the ocean. There are other fuels available, but people are building these large assets with 25 to 35 year lifespan, and they need those assets to have a solution today. And that solution is advanced biofuels. So, I mean, steeper energy, we think we have a solution for long haul transport. That's where we'll always focus. And there's demand today. I think it'll continue into the future.
And can your technology be deployed at small scale as well as the larger scale you were showing us in your slides? Great
question. Our focus right now is forestry because it is a large scale application and relevant. We do have a solution for smaller scale, which is, so for large scale, you're actually buying feedstock to make a project work. For smaller scale applications, you're getting paid to take a feedstock, a waste feedstock. So things like urban organic wastes, municipal solid, organic fraction municipal solid waste or food waste, or anaerobic digestion waste, digestate coming off anaerobic digesters. So manure management, things like that will work as long as you can get paid to take the feedstock. And that really reduces the scale down to about a quarter of what we envision as commercial scale. But that's a secondary focus for us into the future.
Okay, and I guess the last question, we're running out of time here, Chad, but I was intrigued by all the variety of feedstocks that you were able to take and convert into your personal care products. And I mean, some people are suspicious when you hear the term feedstock agnostic, but maybe you could comment on that a little bit. And then very briefly, you did talk about, where you're going to build your commercial plant, after you finish with your pilot. In fact, even where you're going to build your demo. Are there any particular areas that you're already looking at that, are appealing from the feedstock point of view?
Well, certainly, let me talk first about the feedstocks. I can use any oil, any organic oil that is composed of triglycerides. So most of the oils that are used, for example, for cooking, those are highly refined triglycerides. So the same feedstocks I can use, but I don't need anywhere near the kind of refinement that they use for food applications. So so seed crops all have oils in them that I can use. In terms of where we're going to build commercial plants, a lot of that is going to depend on who the customer is. Most of the people or the companies that we're working with, like Lubrizol and Valvoline, have global presence. And so where are their growth areas? And that's where we will want to be. And we'll pick the feedstock based on where the plant is. So for example, if we wanted to build something in Canada, we'd probably do it in the prairies where we're close to canola as a feedstock. In the United States, it might be soybeans. So it would be the Midwest and upper Midwest. If we were to go to Asia, in India, there's a huge push to grow jatropha for diesel. We can use that same material to make our products and give higher value to the farmers there for that same crop. So that's how we would decide when and where to put our plants.
Understood. Very good. Well, listen, guys, it's now 10 to the hour. And as you both know, the title of this conference is Scaling Up. And so it's been fascinating, and part of the reason why I wanted to chair this session to get your two industry scale-up case studies. And we're really looking forward a year from now in November 2022, and I hope we'll be all together in a room and drinking scotch, that we can hear the latest update from both of you on your scaling up journey. And to you, Alex, I want to thank Steeper Energy for being the host of this particular session. So thank you both very much. We actually now have a very short break. The next session is going to begin at 1500 hours or 3 p.m. So in about 8 minutes. And that session is sponsored by Cumberland Strategies and is going to be looking at Canada and United States policy perspectives. And Alex, you mentioned the clean fuel standards. So Ian Thompson, the president of Advanced Biofuels Canada, is going to be talking about the clean fuel standard, Canada's clean fuel standard. And then Chris Hessler will be talking about the US whole of government climate strategy, which is very apropos considering, all of the world leaders, with the exception of China and Russia, are in Glasgow right now talking about the climate strategy and how we're going to meet our 1.5 degrees. So tune in about 8 minutes time, and that'll be when the next session starts. So thank you very much, both of you.
Thank you.
Bye.
Bye.
And then we should put up the slide, Eva, that says that the event will resume at 1500. Welcome back, everyone. We're now going to feature Canada and US policy perspectives that are relevant to the emerging industrial bioeconomy. Our session chair is Bliss Baker, and our speakers are Ian Thompson, President of Advanced Biofuels Canada, who's going to speak about Canada's Clean Fuel Standard, and Chris Hessler, Managing Partner of AJW, who's going to speak about the US Whole of Government Climate Strategy, which is very relevant considering all of our global leaders, with the exception of Russia and China, are in Glasgow right now, talking about our climate strategy going forward. So welcome, Bliss, Ian, and Chris. And Bliss, over to you.
Oh, thanks very much, Jeff. Thanks for the opportunity to be here today as I adjust my camera. As Jeff said, my name is Bliss Baker. I'm the chairman of Cumberland Strategies, where we represent a number of companies in the bioeconomy space and in the biofuel space, from biodegradable plastics to biogas plants, et cetera. But I've also been in this sector and in this space for over 20 years. I think first met Jeff 22 or 23 years ago now, which is not something I readily want to admit, but it's been over 22 years since I've been in this space. And during the course of those 20 some years, I got to meet a lot of great people in this industry globally. And two of them are here today. And Ian Thompson from Advanced Biofuels Canada, worked with him many years ago. And he has since been pushing hard on many things biofuels related, but particularly the Clean Fuel Standard in Canada. And he's been on the front lines of pushing that for some time now, and it's an all-consuming job, I'll bet. And so he's with us today. Ian has a brief presentation, and then Chris Hessler, who I've also had the pleasure of working with over the years, as a well-respected Washington, D.C. lobbyist. I don't think he'll mind me saying that, but he's one of the top clean tech bio industry lobbyists in the US, and has a great practice down there, and happens to be a great guy as well. So Chris will also have a brief presentation, but why don't I turn it over to Ian first, and he's got a presentation, and we'll save some time at the end for some questions. I've got a few questions lined up, and I'm sure our guests today will also, or the participants will also be sending in some questions. So over to you, Ian.
Thanks very much, Bliss, and thank you very much to Jeff for this labor of love that you call the Scaling Up invitation to join you and Bliss and Chris today. As Bliss said, my name is Ian Thompson. I'm the president of Advanced Biofuels Canada. As we get underway, I do wish to acknowledge respectfully that the land from which I'm joining the webinar is the traditional, ancestral, and unceded territory of the Squamish Nation. For those not familiar with our organization, Advanced Biofuels Canada is the country's national advanced biofuels trade association. And since 2005, we have worked with provincial and federal regulators and policy staffs and clean fuel stakeholders broadly on virtually every fuel and carbon regulation in Canada. Our members are globally leading technology developers and facility operators. They transform pretty much any kind of bio-based, synthetic, or waste-based feedstock using a range of technologies to produce advanced fuels for the road, transportation, aviation, marine, and freight sectors, as well as industrial applications. And the next slide will show the map, and I'm just checking, Bliss, that folks can see that slide up on the screen. I'm looking for the nod. Indeed, excellent. And I'll just give a next. So just a simple map here. Our membership has grown substantially over the last half decade, zeroing in on about 30 members. And you can see that they are from a wide array of technologies, some of them producers, some of them feedstock suppliers, some of them service providers, and others such as Halder Topsoe and Honeywell UOP have technologies in virtually every refinery in the world. Next slide. Just very simply, a decade ago, this list of technologies, products, and co-products was a much shorter list than it was today. That made, by the way, promulgating regulations a much tougher job because you were promising things. Today, we've proven these things and they're in use around the world. And the last half decade has seen an explosion of commercialized technologies. And there's a whole pipeline of high promise, low carbon fuels stacking up. Just one note about this, by the way, in the context through Canada for a just transition for people who work in the petroleum fuel sector, the current generation of technologies in my membership look and operate a lot like a petrochemical complex, and they use combination of thermochemical and biochemical processes. And a number of them also produce fully functional drop-in fuels that are 100% compatible with existing vehicles and infrastructure. There's a great handover there. Next slide. I'm going to, you'll see up here 3 tabs, one called the Canadian Transportation Fuels Dashboard, the other Net Zero Clean Fuels, and the most recently an ABFC members map. These are a number of resources that you'll find on our website. Net Zero Clean Fuels particularly is a site that we launched in November, and I'll be pulling from that site for some of my content today. So before we kind of zoom in on the clean fuel standard, I want to offer up a few observations about the path to net zero for Canada and how renewable fuels and particularly advanced biofuels are indispensable to achieving our near-term and long-term goals. And the slide entitled Renewable Fuels and a Clean Fuel Standard and Net Zero Future lays that out. I want to preface my comments today by really stating the obvious, that there is no conceivable scenario in which all existing liquid transportation fuels can be replaced with liquid or gaseous renewables, period. The scale and pace of decarbonation will be so demanding that we must make all efforts to accelerate electrification, to advance hydrogen, to give other emerging energies every fair opening and shot at the market. We've seen expert predictions miss the mark by a mile. So it's hard to call you want to make everybody have a fair shot. There are going to be debates, of course, about where to prioritize, but no one solution can possibly carry the day. It is the case that biofuels have supplied the vast majority of credit generation to date in LCF programs. That will change. It's got to change if we were to keep dialing up these programs' ambitions. I just want to check, Bliss, that we're advancing the slides to the 6 bullets. So anyway, we need a pragmatic view of the energy transition and an eyes open view of the nature of the obstacles. So if we could just advance to the 6 bullets that are there, I'm going to make sure that I can see what's here in the deck.
You're good, Ian. It's up. The 6 bullets are up.
Excellent. Thank you very much. So the key messages, they're really simple, high level. 1, significant ICE emissions, internal combustion engines, they're unavoidable through 2050. It's not just my opinion, that is the consensus of expert predictions, and we'll touch on them briefly. The real question is the profile of those emissions coming out of those internal combustion engines. The second one, cleaner fossil fuels have limited greenhouse gas reduction potential. I'm not saying that cleaning them up isn't important. In fact, it has to happen. It's going to be part of Canada's journey to net zero, but it can't be the primary focus, and we'll look at the science of essentially says why. 3, conventional biofuels carbon intensity trajectories is headed to net zero as a result of the increasing adoption of net emission technologies, or NETs. And one only has to look at the last almost decade of experience in British Columbia and the reporting from Dr. Michael Rensing's group on the reductions in CI and ethanol and renewable diesel and biodiesel over the past decade. They're remarkable. I think about 60% on a weighted average basis. So 4th, this point covers our need to expand how we define the pathways to net zero. A zero emission vehicle is zero emission only if the energy it uses is zero emissions. even in jurisdictions with largely entirely renewable energy, these sources are not zero emissions. Even in a province like BC, where I live, our power generation is 98% renewable. Our consumption, because of power trading, still has substantial coal and gas as the source. So the real metric here is the full life cycle, not just what comes out of a tailpipe. So pragmatically, we have two necessary and complementary paths to net zero transport emissions. One, net zero or net negative clean fuels in internal combustion engines, and zero emission vehicles using low or zero carbon intensity energies. And then lastly, advanced biofuels and synthetic renewable fuel technologies are already deployed globally at commercial scale, and they'd be scaled further up. A nod to Jeff for nailing that one. So let's zero in on the next slide called California Transportation Energy Demand 2017 to 2050. And we pulled this from recent modeling, I believe last April by UC Davis working under a California EPA contract, and they modeled out what it would take to achieve a near net neutral transportation sector in the state. And what's interesting about this is that this is California. California, hard to argue against the stringency and the urgency with which they're pursuing decarbonization. Even in California, they're looking at 43% of the final transportation energy demand is going to be supplied by advanced ethanol, renewable gasoline, renewable diesel, and sustainable aviation fuel. Critical. Folks on the webinar will know that does not mean that 43% of the vehicles on the road will be that, because of the energy efficiency inherent in electric vehicles, for instance. So that's a challenge. It's right there in front of us. Next slide, called ICE Market Share to 2050 Canada. So this chart zeroes in on Canada's light duty and heavy duty fleets using Navius data from Navius Research that we dug into earlier this year when we were putting our netzerocleanfuels.ca website together. Some folks will see this chart and recognize it as also coming out of the Canadian Institute for Climate Choices, which also used the Navius Deep Decarbonization data set. What we see here is the time frame for the crossover point when the number of ICE vehicles on the road is overtaken by EVs, hybrids, and fuel cell vehicles. Clearly in light duty, the crossover is sooner because electrification of light duty vehicles is a more advanced pathway than it is in heavy duty. The message here, pretty simple. ICE emissions will be here for a long time. The critical challenge is to fuel them with sustainable, energy-dense liquid and gaseous fuels that will make these vehicles on the road part of the net zero solution. Next slide, please. Okay, to the subject at hand, now that we've kind of teed it up. Clean Fuel Standard design, Clean Fuel Standard draft design. So let's take a look at the design here. This looks at the compliance pathways. Some of the flexies begin to explain why the regulation, in our view, and that of other stakeholders, is unlikely to lead to significant uptake of fuels critical to our 2030 net nationally defined contribution, NDC, and our net zero 2050 targets. Before I launch into enumerating the array of challenges and issues with this regulation, I want to head off at the pass any speculation that the only solution to correct the problems I described will entail complex, extensive, time-consuming delays to the draft regulation. There's good news in that regard. We've been discussing with ECCC for a number of months a simple, elegant, precedented, and principled solution that will return the CFS to a design familiar to clean fuel investors, and one that's fully aligned with Canada's near-term and long-term targets. This CFS under our proposal would also be fully viable for obligated parties and at a cost well within acceptable levels. And importantly, we can stick to current implementation guidelines. So to the design. The CFS operates much like other ones do. It requires fuel suppliers to reduce the carbon intensity of the fuels they place into the market by 12 grams CO2e megajoules between 2022 and 2030. The baseline for the 12 grams is a bit complex, so I'll just leave it at 12 grams. It equates to about 13% CI reduction averaged for gasoline and diesel. Obligated parties are refiners and importers of fuel called primary suppliers in the regulation, and they've got 3 broad compliance pathways for meeting their obligation. Compliance category 1, called cleaner fossil fuels, allows actions taken across the value chain of fossil fuel production to generate credits. This would include reductions from carbon capture and storage, or CCS, and oil sand plants, more efficient bitumen extraction, more efficient refining operations, et cetera, and other technologies from the array that are being nearing commercial scale in Canada and will be broadly deployed this decade by many experts' projections. Compliance category 2 is also familiar to people. It uses low carbon intensity fuels to generate credits, and these will be primarily biofuels and renewable synthetic fuels. Compliance category 3, also familiar. It's for selected end use fuel switching. And this will allow specifically electric vehicles, hydrogen fuel cell vehicles, renewable natural gas, and other gaseous fuels to generate credits. Up on the upper right, as a holdover from previous design iterations, up to 10% of a fuel supplier's annual obligations can be fulfilled by actions taken to reduce the carbon intensity of solid and gaseous fuels. However, no requirements that these fuels be associated with transportation. While that provision is a flexibility not found in other low carbon fuels, there are a number of other flexibilities that cumulatively cause the CFS to function more like a cleaner fossil fuel standard, frankly. Our CFS will be misaligned with the standards found in California, British Columbia, Oregon, and the EU. On top of these flexibilities, actions taken to meet provincial regulations will count towards CFS compliance. That's not unreasonable, but you have to be accommodating of it if you want a stringent design. And together, the flexibilities and the counting of provincial actions, they raise the risk for potential investors looking to add substantial new capacity in non-fossil clean fuel production in Canada. I'm just going to briefly review the flexibilities of greatest concern. Number 1, crude oil and gasoline and diesel, when exported, can create credits used for compliance. Canada exports 4.1 million barrels of crude a day alone. Allowing obligated parties to use credits from exported product is an absolute no-no in all other clean fuel regulations anywhere. And this particularly egregious aspect of this provision is that non-fossil clean fuels must retire any credits before they are exported. That clearly breaches the CFS scope, which is to reduce the CI of fuels used in Canada. And that differentiated treatment is also clearly not technology neutral, places non-fossil clean fuels at a disadvantage. My members have to retire their credits when they export RNG, electricity, etc. This unprecedented incentive also contributes to fossil fuel lock-in. We'll discuss that shortly. Second, industrial facilities that capture and store the carbon from their process emissions are allowed to generate credits in the CFS. Chemical, fertilizer, steel, cement, pulp and paper plants, all of these industrial facilities and others that have no relationship whatsoever to transportation are allowed to generate credits into what Environment Canada has clearly called a transportation fuel standard. Again, this is incongruous. Third, obligated parties who are short credit at year end and after exhausting other provisions are allowed to comply with 10% of their obligation by paying into a research and development fund of their choosing. That has no requirement to actually reduce emissions. BC is the only other jurisdiction to have a kind of buy your way out provision, but it allows investments into building out infrastructure, which the CFS does not, to support the supply of low carbon fuels. So at least this has a direct link to the near-term supply of low carbon fuels. Fourthly, fossil fuel pathways under CC1 will use quantification methodologies, more or less like a protocol in an offset system, to allow fossil fuel credits to generate credits, projects to generate credits. The range of allowed projects is essentially unlimited. There are additionality provisions attached to them, but it nonetheless places the CFS far outside the other clean fuel programs designs. Next, and this is the top right of the round bullets at the bottom. In a decision in June 2020, Environment Canada added slightly to the stringency of the year 2030, moving from a 10 gram to a 12 gram target, but did so in exchange for a delay to the effective start of the program to 2026. In that year, fuel suppliers will need to generate new credits because they will have fully used credits generated from provincial actions and from credits generated and banked from before the regulation became law. Again, no other regulation has delayed the start in this manner, and all clean fuel regulations require real reductions, no banking, from day one of the regulations, not 4 years later. Many on the webinar understand very well that there's an intense competition for global clean tech investment dollars. The billion-dollar private equity funds, pension funds, et cetera, have deep knowledge of the markets and policies, and their investment decisions begin and end with being able to understand and contain risk. Our CFS, as drafted, leaves too many areas unresolved regarding a level playing field for non-fossil clean fuels. Fortunately, we can level that. I'm going to talk about life cycle and land use at the end of the presentation. Next slide is entitled CFS and Fossil Lock-in. And many will be familiar with the term. I've described the array of flexibilities and provisions that will fundamentally suppress demand for non-fossil clean fuels. But there's another potentially more serious risk from a climate action Canadian point of view. The climate action literature and expert opinion has identified how policies, or in some cases lack of them, can make us more reliant on fossil fuel, and the term they've attached to that is lock-in. In the case of the CFS, the current design over-incents Category 1 or compliance Category 1 actions out to 2030. For every year that the CFS delays the adoption of fuels that are compatible with a net zero future, which we'll show shortly are not fossil-based fuels, we make decarbonization every year that follows that much harder. And it's just clear that if you are a sector that pours billions of dollars into taking the carbon out of your fuels, you're not going to let go of the importance of those investments into your revenue streams, et cetera. So fossil fuel lock isn't a key part. Also note here that one category of CC1 credit generation, carbon capture and storage, our latest tally, and this is out of date by about 8 megatons, was at 47.6 megatons. So we're talking about 3 times the entire compliance obligation of the CFS. Next slide is a very recent development. This is called Proposed Oil and Gas Regulation, CFS Impact. And just yesterday, our Prime Minister at COP26 finalized or added certainty to the August 30th Liberal Platform pledge to regulate oil and gas emissions. And this is a serious curveball for the CFS. Now, what this proposed regulation will do is to send a distinct and near-term signal to obligated parties and crude oil producers who can generate significant CFS eligible credits. The compliance Category 1 actions are not just an option for them, but an absolute requirement. The fuels covered by compliance Category 2 and 3 will have no comparable federal signal. The RFS signal is going away for biofuels. This unlevel playing field in favor of fossil fuels just got tilted even further, and the risk just went up. Some may say, well, we'll take care of that with additionality rules that will protect the integrity of the CFS design. But decades of work in this realm make very clear that investors don't build on promised rules. They build on the basis of final regulation with transparent rules without extensive complexities. It will be years before we have clarity on this proposed regulation. So more delay. If there's some good news in this proposed oil and gas regulation, at least relative to the clean fuel standard, is that it is now abundantly clear that the CFS needs to have some overarching protections against overwhelm from fossil-related credits. We need those protections now, not when they propose regulations and design, and not when the CFF comes up for its midterm review later this decade. The proposed solution I referred to earlier, we'll get to it, would fully address the new risk that this proposed regulation raises. Next slide. Really simply run through this. Sort of how did we get here? We started with 30 megatons, and I've been talking about the flexibilities, but there's another aspect of it. It's just the overall ambition of this regulation. We started at 30 megatons in November 2016. In 2017, the draft regulatory framework determined that we were going to have a partition between liquids and solid and gaseous. A year later, in 2018, a regulatory design paper pegged 23 megatons for liquids, 7 megatons for solid and gaseous. In December 2020, when the Canada Gazette won, the full draft regulation was tabled. The regulatory impact assessment statement that was published with the draft regulation stated that the clean fuel standard was anticipated to create 17.5 megatons of GHG reductions, incremental. Finally, in July of this year, ECCC opened up the draft regulation to remove 3 of the 5 liquid fuel classes from obligation: heavy fuel oil, light fuel oil, and heating oil, with the declaration that these were being removed to return the standard to a transportation regulation. Removal of those 3 classes removed another 2 megatons from the CFS design. So we're now down to 15.5 megatons. So full circle, 30 to 15, and now we are from liquids, solids, and gaseous down to gasoline and diesel, which looks an awful lot like a traditional LCFS as far as scope. I've put a question mark beside jet fuel. It's not in the scope of the regulation as an obligated fuel, but ECCC is considering a potential opt-in status for low carbon aviation fuel at some future date. What else do I want to say about this? I think there has been a world of change since 2016 when this regulation was announced. Net zero commitments were not even on the radar. Proposed actions in the oil and gas sector to meet net zero 2050 were non-existent. No one can now miss the flurry of announcements coming out of the oil and gas sector regarding huge projects to reduce the carbon intensity of fossil fuels. Again, really important and critical to Canada and critical to our fossil sector that we do this. However, this will have an impact on the CFS was simply not anticipated in 2016 when the basic framework was laid out and many flexibilities were enabled to ease the role for obligated parties. Fast forward, and the world of 2021 makes the CFS design much of an anachronism. Recall that actions to be provincial regs are part of the deal. TIER in Alberta, OBPS elsewhere, carbon pricing will have a role. Now it's really difficult to assess what the additionality will be. Modelers have said that the CFS's actual incremental demand might be 7 megatons. More recent modeling showing possibly best half of that and possibly no tons. So new modeling is expected. I'm going to a couple more slides here, and then we're going to wrap up. The next slide just says, are fossil clean fuels the solution to net zero 2050? And what does net zero 2050 mean for CFS design? Here's the core of our proposed solution. If you look at what comes out of a tailpipe, when you turn on your car, 76% of the greenhouse gas emissions that come out are from the carbon in crude oil, and only 24%, and this is based on the average oil sands crude average for gasoline and diesel, only 24% come from the fossil fuels that went to process crude and process refined product that actually goes into your tank. Technologies as CCS and oil plants, the ones I've described, they can reduce some of that 24%, but you can't eliminate. In fact, if you eliminated every last gram, you'd still be left with 3/4 of the emissions untouched. So in other words, you can't CCS a car's tailpipe. The basic science here provides us with the core of our recommendation to fix the CFS. The only solution to addressing the 76% of full life cycle emission is the adoption of the fuels and energies that are on the right-hand side of the slide. These fuels essentially displace demand for crude oil and increase demand for biofuels and non-fossil synthetic fuels, renewable natural gas, electric fuels, and hydrogen and other alternatives. Next slide. So here's the solution. We steal again from California modeling, the same study that I referred to earlier, said what would it look like if you took the finished fuels carbon intensity to zero by the end of the decade, by 2045, near zero. You would have to have 86% of the credit generation or the reductions coming from that list of fuels in the previous slide. So for every 1 credit of generation from a category 1, you would need to have 6 credits from categories 2 and 3. Move over to the right. We're proposing what is called a net zero guardrail. Remarkably simple. It simply calls for compliance credit utilization to mirror what the life cycle is of fuels. So crude and refining process emissions are 24% and tailpipe emissions are 76%. Category 1 compliance, which includes CC1 and cross-stream and all of the flexibilities that are in the standard would remain, but they would be capped or have a guardrail at 24%, and category 2 and 3 would be essentially required if an obligated party fails to meet that, they'd hit the guardrail and stay on the road. It's elegantly simple. I'll only note, just referring to the Prime Minister's comments yesterday, he said regarding the oil and gas emission, we want to ensure these emissions decrease tomorrow at a pace and scale needed to reach net zero. I'm a simple guy, so I'll take those at face value to mean that one would expect transportation emissions to also be reduced on a trajectory and a pace compatible with net zero 2050. Canada cannot decarbonize its transportation sector and not hew to what we've got here up on the chart. We've got to deliver 3/4 of our emissions from non-fossil clean fuels. There's just no way around it. I'm going to go to one last slide, and then I'm going to wrap with apology for going on. A handful of other comments, other areas that a number of stakeholders are zeroed in on. One is land use and biodiversity criteria. Quite very simply, Canada is looking to align more closely with our largest trading partner. And in their renewable fuel regulations, they have for, I think now almost a decade, very closely monitored land use change under their renewable fuel regulations, and Canada is included in that regulation. So we have a practice and a framework that works, and we can adopt that. Farmer declarations, they provide little additional assurance of on-the-ground sustainability. Again, aligning with the US system would work well. Agriculture and forestry supply chains need lead time. So we need these LUB criteria to work. The new life cycle model is a bit of a black box. It's problematic for credit generation, and we need transparency. We're looking to have the Stakeholder Technical Advisory Committee convened as soon as possible to allow obligated parties and all of the other stakeholders of the CFS to understand the critical role that carbon intensity scores will play. Lastly, I've referred to sustainable aviation fuel. We're looking to some kind of ruling for an opt-in or potential reconsideration in the first review. I'm going to pause there and let Chris take it up. Thanks.
Thanks, Ian. Are you with us, Mr. Hessler? You ready to go?
I am. I am not able to go on video for some reason. Jake, maybe, there we go. Okay, great. Great, thanks. I'm gonna just do a real quick overview of how things are proceeding right now under the Biden administration and what implications that may have going forward on biofuels. 3 basic points here. One is there's real change in how the Biden administration is approaching the climate challenge. Second, there are some real clear, predictable outcomes that are going to come from that, but then there's a whole raft of unpredictable potential outcomes. So we're just going to touch on all of that very quickly. energy. Jake, next slide. So the administration really learned a lot of lessons from the Obama approach, and they didn't want to just repeat the Obama approach. They really kind of reinvented it. And some of the political barriers that were obvious that they wanted to address was sort of this divisive tone in the debate about how do we address climate change. And so they took a real clear look at sort of an all-inclusive energy transition narrative that is focused on jobs, including jobs that come from traditional sectors, the oil and gas sector and chemical sector, and asking the question, how do we make sure everyone's involved in the energy transition rather than saying we're creating a bunch of winners and losers. The other is that just looking across government and focusing on really bringing in some specific targets and some specific roles for some of the agencies that had really thought it wasn't part of their job to be thinking about this stuff. Next slide, Jake. The most clear illustration of that was the creation right at the start of the administration of a domestic policy advisory role in the White House for addressing climate. There are only two other domestic policy advisors with councils arrayed around them in the White House. One is the National Economic Advisor, and the other is the National Security Advisor. So climate has now taken its role in the Biden administration on par with those. And this is a serious operation run by Gina McCarthy, who used to run EPA for Obama. She's brought in a fantastic team of really seasoned professionals who are digging in and making this whole government strategy work. Next slide. So there are things that they can do in the immediate term with the tools that they have, and there are things they can plan for in the long term with the tools that they've got. So they've made a bunch of pronouncements around near-term and short-term, near-term and long-term implementation to get at a whole host of outcomes using existing authorities. And next slide, Jake. That is true. They're bringing in sort of the question of what does each agency, what are the interactions between the agencies? So, transportation is not left out on the sideline. They're working directly with energy and working with EPA, but they're also working with the Department of Defense, trying to figure out all of the different components of these things. So every agency is now at the table thinking about this as an interrelated problem. And that's a really different strategy for the US if we just haven't done anything like that, sort of comprehensive multi-agency engagement. Next slide, Jake. And if we look at sort of one agency and think about where it's drilling down, traditionally, the Department of Energy is an R&D agency, doesn't do a lot on deployment or regulation. And frankly, its engagement on the climate change debate really only started in with the 2008 energy bill. There certainly were 2007 energy bill, forgive me. There were certainly things that were doing that were fundamental on R&D for wind and solar and stuff like that, but that wasn't really thought of as a climate change charge. They're in it in a big way, but this slide sort of hints at some of the things that are proposed and Congress is currently considering. I didn't write out all the different ways that pending legislation could affect the bioeconomy because I didn't want folks to get falsely enthusiastic. This legislation has been basically pending in Congress and under debate in Congress since the spring. And we still don't have a bill. The president pushed really hard to get final passage before he flew off the COP and was unable to do that. There have been lots of pronouncements about any day now we're going to get the votes. It's all going to be sorted out. But there's still fundamentally some pretty different, serious conversations going on around the size and what happens with various different provisions. So stay tuned. There is a multi-trillion-dollar combination of bills that could have roughly $500 billion dedicated to climate action, but we don't know the details of that with any kind of confidence or certainty. Next slide. So this came out just yesterday. This was sort of the work of Gina McCarthy's shop in concert with the State Department team that is working on the international side of this debate. And this is one area where it's clear that the Biden administration has taken a very different view. They are not just talking about electrification. Their strategy really gets right at biomass for all the reasons that people think about bio contributions to climate change, including it can go faster than some other solutions. It can address things other solutions can't. It really will keep the costs in line with much more reasonable strategies. And you can get net negative outcomes, which you can't get from every climate strategy. So this was a pretty unique take, and not following in exactly the line where some of the NGOs I think would have wanted the Biden administration to go to. And let's just hit that last slide. One other major factor that is starting to percolate is a conversation about a national clean fuel standard. It's building on a growing interest in states to have a clean fuel standard at the state level. And so we've seen, Oregon and now Washington State followed the California example, came within a couple of votes of getting a clean fuel standard in New Mexico in their last session, and that is still very active, and other states are looking at bills very seriously. So the national government, the congressional level, there's some conversations that seem to be, I would suggest, growing in their interest to have the EPA authorized to go in this direction and move on from, or at least figure out something that's in concert with the renewable fuel standard that we've got now, but look at a real carbon accounting strategy around that. That would, if it's a technology neutral strategy, as everyone in this meeting probably understands, would have significant potential upside for bioeconomy strategies and investment. So let me stop there, and Bliss, if we've got time left for some Q&A.
We do have a few minutes left for questions. I got a couple here, and if those if folks participating want to send their questions in, by all means. I do know several people who are probably listening today, and you're uncharacteristically quiet, so by all means, send us a question. The first question
is just to let you know that we can run a few minutes late also, because we got started a couple minutes late, and this is the last session of the day. So let's just continue this robust discussion.
Perfect. I've got a few good questions here. Chris, if you know anything about government, I think it sends a pretty strong signal and a positive signal, the creation of the domestic climate policy in the White House, and given them some teeth, and they brought all the agencies to the table, which is a very good sign. My question is this too ambitious? I mean, government moves at a glacial speed sometimes, and incrementalism is usually the order of operations there. Is this too ambitious, and is it going to collapse under its own weight, or does this ambitious plan have a chance of succeeding?
So that's a great question, and let me speculate an answer rather than saying there's a fact-driven or there's a single answer to that. I think there's evidence for sure, Bliss, that they're being real smart about deploying the tools that they have and doing it rapidly within the boundaries of existing authority. If we look at the pronouncements from DOE on hydrogen, for example, a couple of things are clear. They are using the R&D tools that they've got. They're using their remit to do long-range planning and lay out a long-term strategy for which Congress would have to engage and add funding or add authorities if it were really to hit its marks. But even if we assume pendulum swings in control of government, there's at least a template plan there that others can start to work on. So they're taking a pretty smart strategy to do what they can with the tools in hand and lay out ambitious goals, but no way can they achieve all of it on their own. I don't think we'll see this collapse in a mess, partly because of the seasoned experience that Gina McCarthy brought to her team and the way that this is being implemented across the agencies. I think we're going to see then do what's achievable. What's achievable may be a lot less than people want.
Okay, and I have a similar question for Ian with respect to the CFS. You know, my head was aching and was throbbing looking at that slide on the structure of the CFS. You know, when I started in this business 22 years ago, we had biodiesel and we had ethanol from corn, and that's it. You've got 30 some products now. You've got a CFS that is so complicated, it makes my head ache. Is this thing, you know, is it going to, you know, suffer from the complications? Because getting anything done in government, as we all know, is extremely difficult. And the more complicated it gets, the more difficult it gets to pass and see the light of day. So, you know, I don't expect you to predict the downfall of the CFS, but what's the future look like this? Because I worry about the future of the CFS when I see these slides.
Again, great question, Bliss. Well, I actually will. I will predict. I'm pretty confident that we will see a change in the CFS design. The regulation has already been opened up. They did it to remove 3 fuel classes. There are other things that we understand will be in the work. So the regulation will be amended. We looked at, and this is a complex regulation. We looked at, you know, an approach that would kind of take a scalpel out and go after clause by clause, and it says non-starter, that would just delay, et cetera. So the proposal for a guardrail is highly principled. No one's really arguing that it couldn't be implemented fairly easily from a drafting point of view. And it's kind of where Canada has to go. On top of that, when we went from 30% below 2005 for our NDC up to 40 to 45%, Canada needs the tons. We have to have more tons, and the CFS has gone backwards on tons. It's gone the wrong direction. So I think it's pretty clear in my, you know, our comments about the technologies. The technologies can pull it off. A decade ago, question. But they're done. Look what California's got just shy of a quarter of its diesel pool renewable, and that happened over about 5 years. I mean, remarkable change. If you have a good signal and clear rules that will have people invest, because, you know, the facilities for these non-fossil clean fuels today, they're $250 million, $500 million facilities. They take 3 to 5 years to build. You don't move into those without having a pretty good sense of where you're going. And frankly, what we hear from global investors is that other jurisdictions have cleaner rules, cleaner signals, less complexity. You know, my comments during the presentation, I think there's a real opportunity with this new oil and gas reg to clean up the picture and modernize, and a guardrail would do that elegantly. Wouldn't exactly mimic what BC and California done, but it would get us very close to it. And you know, it's why you are seeing a wide array of non-fossil clean fuel sectors and NGOs really pressing for this change in a pretty unprecedented alignment of voices. So I'm confident we will see an improved CFS.
A question from somebody we all know, Rory Sladek. He's asking about investor interest in climate change strategy initiatives with the new administration down there. Has this administration generated a significant amount of investor interest? What's happening with respect to pools of capital, et cetera?
Well, certainly the smart investors are making smart decisions, and that means a lot of different things. So we saw, for example, just last month, a massive $4 billion announcement from Air Products in a hydrogen production with CCS project down in Louisiana that is really going to advance the availability of clean hydrogen. They're going ahead with that without any need for government involvement, but they're making pretty clear that expanding on that type of project is going to be dependent on having a signal for offtake, more demand for clean hydrogen in its conventional hydrogen uses now, and also expanding the uses of hydrogen for transportation or other applications. So I think we're going to see folks make risk mitigated investments, and things that have rapid payback will probably see some more uptake, but everybody's got to be thoughtful about the possibility of one or both houses of Congress going back to the Republicans in the next election, and the White House potentially going back to the Republicans in the 2024 election. So I don't think anyone should be making long-term bets without awareness of political risks involved.
Just and related to that, Chris, do you have any predictions on winners and losers in the new whole of government approach and the Biden administration's plans? Who do you think are the big winners and losers?
You know, I think we'll know a lot more when Congress finishes up its work on this reconciliation and infrastructure package pair of bills. If they get that done, we'll really have a sense of what stakes are in the ground, and that could, you know, fundamentally alter the tax incentive landscape for the next half decade or decade. It could fundamentally alter the availability of incentive money for things like hydrogen hubs or bioeconomy centers. All of that type of stuff has been sort of in the package, but we don't know until that piece is done how all that plays out. The less Congress is able to put in, the more we're going to see kind of a continuation of small bites at things like incentives for new charging infrastructure for vehicles and things like that, and we'll just continue with the renewable fuel standard or something along those lines. So this is an ambitious swipe, and we'll see what's left when Congress actually gets to majority votes.
Great. Here's another interesting question: from a participant, is there any expectation of an opt-in for a mechanism on the CFS for marine fuel or jet fuel? You may have touched on that, Ian. I think you mentioned jet fuel, but is that a consideration?
I think marine fuels are covered. Jet fuels are the question. Okay.
And maybe this is a question for both of you. Has there been any further discussions, or have been in previous years, about any states or Canadian provinces joining the California LCFS? I know several years ago in Ontario talked about joining the LCFS, and they were joining with Quebec at one point, floating that idea. Are those discussions happening at all for either one of you?
Ian, why don't you go first?
Well, in Canada, on the current trajectory, there's not much to align with, but yeah, I think a long-term, Ontario, California, and Quebec had a shared cap and trade pool. Until Ontario pulled, that was regarded as a model. Could at some point in the future you have alignment where they can share credit generation, et cetera? Yes. When I hear California CARB officials pose that question, they don't rule it out, but it's not on their short list of things to do. They would start first with Oregon, Washington, maybe move to British Columbia. Again, you have to do equivalency. You've got to have platforms that look and function somewhat alike, so you don't have to have a whole lot of caveats to how you translate credits. I don't see it in the works in the short term. In the long term, it would be an attractive feature.
So let me add to that Bliss, our Sacramento office keeps very, very close eyes on the conversation around the LCFS there. And there's been this sort of careful dance. California would love to see much more of the North American market adopts a fuels-focused carbon accounting strategy or price signal, and let the market sort of continue to incentivize investments in new strategies for compliance. But they are really, really careful not to try to be seen leading a band to adopt the California model. They know there's real political hazards of pushing too hard on that sort of narrative. So I think they're willing to work with anyone who wants to seek their input. They've been, I think, very public about that and made themselves available to officials and internationally, who as well as all the states in the U.S. Anybody who wants to talk to them about it. But it's a very careful enthusiasm for others to follow, but wanting them to figure things out that make sense in their jurisdiction.
Super, thanks. Okay, one last question. So over the last 20 years or so, I've been privileged to speak at the National Renewable Fuels Conference probably half a dozen times. And I moderate a political panel, and when I was chairing the Global Renewable Fuels Alliance, and I always ended the panel discussion with a question that always got some great answers. First of which is, make a bold prediction about where we're headed with respect to this space on CFS and the Biden administration's ambitious plans, and then end it with who's going to win the Stanley Cup.
Ian, I'll defer to you again.
Go ahead, Ian.
I already gave my prediction. You know, there's been a fundamental shift in the last 12 to 18 months in the oil and gas sector in Canada, and we've sensed it, and many others have seen it. I think the realization that climate action is here to stay. So I think you're going to see a different oil patch, if you will, that's really leaning and looking to remain relevant in a world where they see a lot of electrification and they want to stay relevant in that world. And so we now have competition's a good thing, right? So, you know, that little sign that says objects may appear closer than they are in the rearview mirror. I think that's what's happening for refiners and upstreamers. And I think that's healthy. So I think there's a lot more room to work collaboratively across the different sectors, because I think we've got a new orientation and lean in from the fossil sector. So I think that's a real positive.
Yeah.
So on the bold prediction side, the scaling up 2022 is going to have a lot more investments to be talking about that have been announced, and where folks are really boldly moving to commercialize things in North America and elsewhere. So I think that'll be my, you know, this $2 trillion number. I think Jeff's going to be able to show some real progress against that $2 trillion a year from now. And on the other question, Bliss, the Boston Bruins, of course. Why are we even talking about it?
Excellent. I noticed Ian didn't even want to take a stab at Vancouver winning the Stanley Cup. All right, so I'll make my bold prediction. My bold prediction will be that EV adoption is going to continue to accelerate, and at some point in the very near future, it's going to catch up with the infrastructure shortfalls, and we're going to have a problem. I'd say a high-class problem, because the accelerating adoption of EVs is not a bad thing. So I think we're going to get to that nexus sooner than we think. And I'm not going to make a prediction of who's going to win the Stanley Cup. I know who's not going to win it, and they wear blue and white. So over to you, Jeff.
You're muted, Jeff.
I was going to say on that last question, Bliss, and I'd forgotten that you used to ask that question at the U.S. Renewable Fuel Standard, but since you didn't say in what year, I'm just going to say that before the Maple Leafs or the Bruins or the Vancouver Canucks or the Washington Capitals win the Stanley Cup, before any of those teams win it, the Ottawa Senators are going to win it. So there's my prediction. Now,
that is a bold prediction, bold.
Jeff. Such a partisan, Jeff. Hard.
Very bold.
Anyway, so listen, guys, thank you very much. Just a quick go round. I mean, Ian, you mentioned that you think that there's a good chance for the guardrail to make it through. Any sense of the timing of that?
I think most people, most observers and participants are anticipating a potentially modest delay to the final reg publication. I think the same group of people see that there is not necessarily any reason to delay the implementation, the actually coming into force and when the signal to the market would go. Yeah, my prediction is that some substantial positive changes could be made in short order, without substantial delay.
Okay, thank you. And Chris, to your challenge that in 2022, we're going to see a lot more of that $2 trillion realized, I'm going to rely on you to help me find those projects, and we're going to we're going to make sure that they're here to present, and then enjoy the scotch at the end of the day, which is what we really should be doing today. By the way, all of you are invited to have a scotch, including the 102 people who are still on the line here, because you know, this is what we would normally be doing at a live event, is at the end of the day, breaking for our scotch tasting at the end of the first day. So listen. Thank you, Chris. Thank you, Ian. Thank you, Bliss. And thanks to Cumberland Strategies, because Cumberland was the host of this session. So thank you very much to Cumberland for their sponsorship. I really wish we had more time to delve into this subject. Interestingly, we just had an election. We've just had an appointment of cabinet. I don't think we have the ministerial mandate letters yet. So I think, Chris Hester, that they're going to show that as far as climate is concerned, Canada is also going to take a whole of government approach, because even with the last cabinet, a lot of the ministerial mandate letters mentioned right from transport to environment to natural resources Canada to global affairs, they mentioned climate change and the environment in their in the marching orders to ministers. So let's hope that Canada takes that whole of government approach. But now it's time to adjourn for the day. So remember, we've got a really important agenda tomorrow, starting with our finance panel. And you know what? We can't get anywhere on spending that $2 trillion, Chris, in the absence of project finance. So tomorrow's session is sponsored by New Energy Risk out of California, and it begins at 11 a.m. Eastern. And then at 12:30, we have a special presentation on de-risking technology, feedstock, and offtake. And of course, we also all know that for a successful scale-up of bio-based projects, you need to de-risk and allocate risk to the parties that are most likely to be able to handle them. And Don Roberts, the president and CEO of Nwitka Capital, will be making that presentation. So once again, I want to thank everybody for their participation today, and we'll see you all tomorrow morning at 11. And this is Jeff Passmore signing off.
Why don't you, Jeff?
Thank you.
Thank you all.